The committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. As a reminder, I ask all members to keep themselves muted when they are not being recognized. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may only participate in one remote proceeding at a time. If you're participating today, please keep your camera on, and if you choose to attend a different remote proceeding, please turn your camera off. Additionally, I want to announce that for this hearing, it is my intention to recess the committee for 5 minutes every 2 hours. Lastly, before we begin, I'd like to take a moment to recognize Congresswoman Alma Adams, who is celebrating her 75th birthday today. Happy birthday, Congresswoman Adams.
Thank you, Madam Chair. Thank you so much.
Thank you. I now recognize myself for 4 minutes to give an opening statement. Good afternoon, everyone. Today, this committee convenes for a hearing entitled Holding Megabanks Accountable, an update on banking practices, programs, and policies. And of course, testifying before the committee today, we will have the CEOs of JPMorgan Chase, Citigroup, Morgan Stanley, Bank of America, Wells Fargo, and Goldman Sachs, who testified before the Senate yesterday. And today's testimony concludes 2 historic days, which are a true testament of the accountability that comes from Democratic control of the House and Senate. As chairwoman of this committee, I have made it a priority to ensure that we're conducting rigorous oversight over megabanks and their activities. We last had all of the megabank CEOs to testify before the committee in 2019. Since then, there have been many developments involving megabanks that this committee will be examining today. I'm eager to hear about the megabanks' response to the pandemic crisis, including their provision of mortgage forbearance, affordable loan modifications, support for extending the foreclosure moratorium, and paycheck protection programs, loans. I'm concerned that the institutions led by our witnesses raked in billions in overdraft fees during the pandemic at a time when so many individuals and families across the country are struggling through no fault of their own. Additionally, some of our banks prioritize wealthier clients for PPP lending while processing smaller loans at a much slower rate, or in some cases, turning small and minority-owned business away altogether. We heard so much about this from all over the country. I've also asked our witnesses to describe their institutions' efforts to reach underserved communities and address banking deserts, where communities do not have access to a bank branch. The 4 largest banks have closed thousands of bank branches over the past decade, and I'm concerned that this is exacerbating the bank desert problem and harming communities that rely on branches for basic banking services. This week also marks the tragic anniversary of the murder of George Floyd, a Black man by white police officers, which focused America's attention on racial injustice in this country. The megabanks responded by making a number of large commitments to support minority depository institutions, community development, financial institutions, and communities of color. Given that these banks have repeatedly been found to discriminate against our communities, the CEOs will be asked to explain if their banks are following through on those commitments and to learn what additional actions they will take this year to address racial disparities that remain pervasive in our banking system. I'm also looking forward to hearing from our witnesses about their progress improving the diversity and inclusion of their senior leadership, their boards, and their investment in diverse-owned firms. Diverse representation at senior levels is key to ensuring a fair and equitable recovery for all communities. There are many other topics of interest to this committee that we will address today, including banks' wages for their employees and compensation for their CEOs, their use of emerging technology such as artificial intelligence or products like cryptocurrency, the recent growth of megabanks and megabanks' actions to address climate risk. I look forward to hearing testimony from all of our witnesses today. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Well, thank you, Madam Chair, and thank you all for being here today. We're here today for the sequel that nobody asked for. In 2019, Democrats held this exact hearing to grill you CEOs on everything from your firm's size to your salaries. Republicans in that hearing used the hearing to focus on systemic risk issues to our current financial system. Clearly, none of us could have predicted what could have happened or what would happen just one later. The pandemic presented us with a once-in-a-generation challenge. Congress, the Fed, and Treasury stood together and met this crisis head on. Your institutions also played a critical role, as did the financial system, generally speaking, banks of all sizes and credit unions of all sizes, and fintechs, making sure that support was available to families and small businesses. You deserve some credit for that. So where are we now? Nearly 50% of adult Americans have been fully vaccinated. Businesses are starting to reopen, and we should be talking about the amazing recovery that has taken place. But I also am very concerned about some of the troubling data that is starting to emerge. The April data from the Bureau of Labor Statistics showed that unemployment increased by only 266,000 people. At the same time, we have more than 8 million jobs remain unfilled. Businesses are struggling to hire workers, and the cost of household goods is rising sharply. Our economy is at a fragile moment right now. To be clear, I agree that things are looking up, and that's great. But make no mistake, there are some very troubling signs ahead. So our focus must be on jobs and getting people back to work. That is what Republicans are doing. In fact, according to the Bureau of Labor Statistics, 17 out of the 20 states led by Republicans are recovering jobs the fastest. But Democrats seem to have other priorities. Their so-called American Rescue Plan actively discouraged people from returning to work. And now they're preparing to ram through trillions of dollars more in spending and massive tax hikes, all under the guise of quote unquote infrastructure. Well, Americans are quite literally being forced to pick up the tab for Democrats' progressive agenda items. And our witnesses might be wondering what this has to do with them. Well, I think this is a cautionary tale. To be careful what you wish for. My colleagues on the other side of the aisle want you, bank CEOs, to focus on political activism instead of doing what your institutions do best, which is provide capital and serve customers. As we learned in COVID, when you mix science and politics, you get politics. And as we're learning now, when you mix business and politics, you get politics. Well, some may say, come on in, the water's fine, but our political waters are quite troubling, and we don't need the business world to become the political world. I don't think we're better for that, and our economy's better for that. And shunning law-abiding businesses to appease to the woke left as well won't help employers, won't help our economy recover, won't help the average working person in America. Instead, we should be working together on a shared goal of rebuilding the greatest economy in the world that we had pre-COVID and moving forward. Speaking of moving forward, Madam Chair, when will this committee get back to normal? We want to urge normalcy for the American economy and for the American people. For months now, we've gone back and forth about returning to in-person hearings with the option for members to join remotely. I think that's a reasonable request again today. I also think the American people we represent would be pretty ticked off if they knew we weren't going back to work for them and not doing what they have to do on a daily basis. I'm encouraged by vaccine able to follow safety protocols available. So CEOs, I look forward to your testimony. I look forward to the questions today. And looking forward to all of us getting back to normal as soon as possible, especially Congress getting back to the work of the American people. Thanks so much, and yield back.
Thank you very much. At this point in time, I'm going to call on Mr. Perlmutter for 1 minute for an opening statement.
Thanks, Madam Chair, and I want to thank our panel for their leadership during this pandemic. None of us expected it, and just thank you for your leadership. The last 15 months have been challenging for our country, but through the leadership of the Biden administration, 50% of Americans are fully or partially vaccinated.
Yeah, they were wondering.
The American Rescue Plan has provided relief to many communities through economic impact payments, help for small businesses, and support for state and local governments. Unfortunately, many Americans remain vulnerable, and there is still uncertainty in our economy. Financial institutions and their employees have been on the front lines of delivering PPP loans to small businesses and working with consumers impacted by the pandemic. As chief executive officers, I'd like you to focus on two things: keeping your institutions safe and sound, and assuring that everyone has access to banking services and all are treated fairly and honestly without fear of sharp or abusive practices. With that, I yield back.
I now recognize the gentleman from Missouri, Mr. Luetkemeyer, for 1 minute.
Thank you, Madam Chair, and thank you to the panel for testifying today. In the past decade, we have seen a trend where the liberal left has tried to use financial institutions to eliminate legally operating industries they do not like, from gun manufacturers to energy companies. This was first attempted under Operation Choke Point, where financial regulators in the Obama administration forced banks to cut services to certain industries. While the last administration largely stopped that, the left now has a new method of accomplishing their goal: publicly naming and shaming financial institutions and applying political pressure to drop companies. In fact, some members of the committee publicly urged you to unbank certain industries at this same hearing in 2019. Unfortunately, a number of banks represented here today have been all too eager to comply, making them willing participants in the systemic unbanking of legally operating businesses in this country, in contrast to investments and operations in other parts of the world. Today, I look forward to hearing why. With that, Madam Chair, I yield back.
Thank you very much. At this time, I ask unanimous consent to respond to an issue, a very important issue that was raised by Mr. McHenry, and engage him in a small, limited colloquy. I want to thank the ranking member for his comments in his letter. As has been the case throughout the pandemic, the health and safety of members and staff are of the highest importance. It is my intention to continue to conduct this committee's proceedings in a manner that is safe and in accordance with the most recent advice from medical experts. Now that we have updated guidance from both the CDC and the Office of the Attending Physician, I'm working with staff to think through how we can adjust committee protocols to allow for hybrid committee meetings. I will note that the latest guidance from the Office of the Attending Physician and the corresponding flexibilities around social distancing and mask wearing are specific to those who have been fully vaccinated. Those who have not yet been fully vaccinated or who are vaccine are still strongly advised to wear a mask and social distance. Further, the updated guidance specifies that there should be continued mask wear and social distancing in committee meetings, due in part to the substantial number of people who are not yet fully vaccinated or who are vaccine indeterminate. Therefore, I look forward to working with the ranking member to ensure that we are verifying the vaccination status of all individuals who are attending in person at committee meetings, including members and staff. I welcome further conversation with the ranking member on how we can move to hybrid proceedings safely without creating unintended issues such as additional technical issues or concerns regarding uneven participation, considering we cannot accommodate all members in person at this time. And I will yield to the ranking member for a limited time for this colloquy.
Well, thank you, Madam Chair, for responding in some context to my letter. What I raised in my letter was that this committee operated in person and in a hybrid format before vaccines were distributed to the public. And I'm asking the chair to return to her standard, which was then the case. That was a standard well beyond what the attending physician recommended then, and is again the case now. We need to show the American people we can safely reemerge. Everyone that wants a vaccine has had the option to get it. In fact, Congress was one of the first branches, the first group of people in the country and in the world that had vaccines available. So all the members that want vaccines have had ample time to do this. And what I'm asking is for us to return safely to work as a sign to the American people that we can do our business and get it done. The digital format, as members and as the public will see today, is a fairly miserable one, given the nature of this technology and with a load on this technology. We were better off with in-person hearings, just like we are, like just how we operate when we have markups and committee markups where we've been hybrid. And the minority has been quite willing to work with you and the majority on doing this safely, as we did in the midst of the pandemic before vaccines were available. So the answers right now, I think, are way too limited, far more limited than what the science indicates, number one. And number two, there is no provision under House rules by which a committee chair or the Speaker of the House can verify somebody's health records. And in fact, important seminal health privacy laws in this country also ward against that. I am vaccinated, and I'm proudly vaccinated, and I think it is the safest vaccine brought to market in global history, and my family's benefited from us. Let's show that we can actually get back to work and be an example for the American people, rather than having this absurdity that we can't be back together safely. And with that, I yield back and certainly understand that we can continue this dialogue in the coming weeks. Chair, for raising it, and I yield back.
Thank you. Thank you so very much. Yes, we must continue this dialogue. I'm very proud to announce that the entire Democratic caucus have been vaccinated, and I'll leave it up to you to deal with your caucus on how you guys are going to deal with that.
Madam Chair,
Yes.
I would, on those health records, as a member of Congress, I have expressed that I am vaccinated. I'm going to leave it up to members to talk about their own health status under their own regard. But Madam Chair, as you and I know, you've got one of the best health records in Congress, and you fear no person. So I'm confident sitting next to you that I'm well fortified and protected. And with that, yield back.
I'm so proud of the Democratic caucus, and I would hope that you would do everything that you can to encourage the members of your caucus to be in the safety mode for all of us and encourage them to be vaccinated. I'm going to move on now. First, we have Mr. James Dimon, the Chairman and Chief Executive Officer at JPMorgan Chase and Company. Next, we will have Ms. Jane Fraser, the Chief Executive Officer at Citigroup, and then Mr. James P. Gorman, the Chairman and Chief Executive Officer at Morgan Stanley. Next, we will have Mr. Brian T. Moynihan, Chairman and Chief Executive Officer of the Bank of America, and then Mr. Charles F. Scharf, Chief Executive Officer and President, Wells Fargo and Company. Finally, we will have Mr. David M. Solomon, Chairman and Chief Executive Officer, Goldman Sachs. Without objection, your written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony. You should be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I would ask you to be mindful of the timer and quickly wrap up your testimony if you hear the chime. Before we begin with your oral testimonies, I would like to swear the witnesses in. I will call each of your names individually to respond. Would all of you please raise your right hands? Thank you. Do you solemnly swear to affirm that the testimony you will give before this committee in the matters now under consideration will be the truth, the whole truth, and nothing but the truth? So help you God. Mr. Dimon?
Yes.
Ms. Fraser?
Yes.
Mr. Gorman?
Yes.
Mr. Moynihan,
Yes.
Mr. Scharf,
Yes.
Mr. Solomon.
Yes.
Let the record show that all of the witnesses answered in the affirmative. We will now begin with their oral testimony. Mr. Dimon, you are now recognized for 5 minutes to present your oral testimony.
Chairman Waters, Ranking Member McHenry, and distinguished members of the committee, I, the proud grandson of Greek immigrants, appreciate the invitation to appear before you to talk about JPMorgan Chase, including the people, businesses, and communities we serve. We are living through unprecedented times for which history will judge the leaders of government and industry by actions we take to address the health and economic crises and longstanding structural inequities. At JPMorgan Chase, we entered this crisis from a position of strength and leverage our size and scale to contribute to the stability in our country and ongoing support for the real economy, our customers, employees, and communities impacted by the global crisis. In 2020, we extended credit and raised capital totaling $2.3 trillion for customers and businesses of all sizes, helping them meet payroll, avoid layoffs, and support operations. We waived fees and delayed payments on about 3 million accounts for customers who said they were affected by COVID with no questions asked. We waived over $600 million in fees for COVID and non-COVID reasons, including over $400 million in overdraft fees. We funded over 400,000 PPP loans to small business, supporting over 3 million jobs for more than $40 billion in total funding. About 90% went to businesses with fewer than 20 employees, and around 1/3 went to businesses and communities of color. Outside of PPP, we provide $18 billion in new and renewed credit for small business. We committed $250 million in business and philanthropic initiatives with the focus in helping underserved small businesses, not profits. And we support our employees, especially our frontline workers, of which something like 75,000 went to work every day, including me, for the most part, who continue to show up to their jobs in branches, call centers, lock boxes, and other roles that could not be done at home. We gave special payments, additional paid time off, and continued to pay for regularly scheduled hours, even when hours were reduced. There's no doubt that the bold and swift action taken by Congress, you all, the Federal Reserve, and the administrations over the past 15 months were instrumental in reversing financial panic and avoiding a deep and lasting economic crisis. But the last year exacerbated longstanding inequality, particularly among Black and Latinx families, increasing barriers to wealth creation and holding us back as a country. This is why JPMorgan Chase recently committed an additional $30 billion over 5 years to address racial economic inequality, focusing and expanding affordable housing, growing Black and Latinx-owned businesses, and improving access to banking. These are new business commitments that will help to drive real change. We've already made solid progress and are on track for a 5-year commitment. We've refinanced over $2 billion in mortgages for Black and Latinx households and have funded investments and loans for an additional 5,500 multifamily affordable housing units. We funded over $60 million in investments in We also opened community center branches in areas like Harlem, Chicago, Minneapolis, and Crenshaw, with many more coming in the next year. At JPMorgan Chase, we consider our people to be our greatest strength. Our 160,000 U.S. employees are located in 38 states and soon will be in 48 contiguous states this summer. 30% of the new branches are opening are located in low to moderate income households, and nearly 1/3 of all branches are in minority census tracts. For the third time in 5 years, this year we increased entry-level wages to $16 to $20 an hour, and we provide annual benefit packages worth about $13,000. Nearly 70% of our employees who started before 2017 with a salary less than $40,000 are still at the company and have experienced an average increase of 40% in compensation. We've also made progress in recruiting, retaining, and promoting ethnically diverse employees. Over the past 5 years, for example, we've increased the number of Black senior leaders by more than 50% and established a new program that holds managers accountable for the diversity priorities through compensation and performance evaluations. Our country is poised for a strong economic rebound, but we must ensure the economic recovery benefits all and that we address longstanding inequities that threaten the promise of America. Access to affordable health care and education system that's failing too many of our children, crumbling infrastructure, climate change, and racial inequality are some of the problems challenging our great nation. All of us, government, business, and civic society, must work with a common purpose to address these challenges. I want to close by thanking our employees for their tireless work and relentless focus on doing what's right for our customers. They have performed their jobs with integrity and commitment, to serve our customers and our country. I look forward to working with you all as we shape our future of our country for generations to come. We all share a collective American interest to ensure that we are a country of unlimited opportunity for all. Thank you.
Thank you very much, Mr. Dimon. We will now go to Ms. Fraser. You are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairman Waters, Ranking Member McHenry, and members of the committee. And thank you very much for the opportunity to represent Citi today. By way of introduction, my name is Jane Fraser. I joined the bank 17 years ago, and I became CEO in March. I grew up in a small village in Scotland, but I first came to the US in 1987. And I very proudly became a citizen in 2001. My husband immigrated to the US from Cuba when he was a young boy, and he's also a proud citizen of our country. So we both feel very fortunate about the opportunities this country has created for our family, and we believe we have an obligation to make sure everyone can participate in the American dream. At Citi, we recognize this has been an incredibly challenging time for Americans, millions of whom we're very proud to call our customers. The origins of this global crisis are very unlike the last one. This is a public health crisis with severe economic consequences for many. Through the pandemic, Citi has shown we are a very different bank than the one that entered the financial crisis more than a decade ago. We're smaller, but we're safer, we're stronger, and we're far less complex. We have had the financial resources to support our clients and communities through COVID, and we're laser focused on driving a sustainable and an equitable recovery. I'll always be proud that we were the first bank to provide relief programs for retail and small business customers in the US. We're also proud to be a reliable conduit for the extraordinary consumer and business aid that Congress and the Federal Reserve have provided. We help deliver this aid across many government-sponsored programs, including the Paycheck Protection Program. As a result of the tremendous need from small businesses, we went from being a relatively small SBA lender to so far funding over $5 billion in PPP loans to the hardest hit small businesses, and nearly 80% of these loans have gone to businesses with 10 or fewer employees. And we're donating all the net profits from the program to provide further support to vulnerable small businesses and communities in the US. And at the same time, we've made our own people a priority. We provided them special compensation awards and benefits to many of our colleagues to help them ease their personal financial burden and worries through the crisis. As the world's most global bank, we will continue supporting many of the most iconic American businesses as they navigate the uncertainty of markets abroad. And working in concert with federal assistance programs, we're going to continue to serve as a source of strength for our customers and our communities here at home as a very high priority. While we have a smaller branch footprint than our peers, we will harness the full power of our bank's capabilities to extend our reach and to help make sure the recovery leaves no one behind. We're proud of our record of enabling opportunity in communities. For 11 straight years, we've been the #1 lender of affordable housing in the US. And in 2020 alone, we worked with the state and local governments to finance over $27 billion in vital capital projects such as roads and schools, hospitals, and utilities. And through low cost and no fee products, we continue expanding financial services in underbanked neighborhoods. Almost exactly a year ago, as calls for social justice rang out in the wake of George Floyd's murder, Citi answered those calls with action. We launched a firm-wide effort, including $1 billion in strategic initiatives to help close the racial wealth gap. And just this morning, we announced a new $200 million program to invest in affordable housing and workforce projects with Black investment managers. We're not alone in our commitment to equity, but what distinguishes us is how we hold ourselves accountable for results. And where we have more work to do, we're very upfront about it. This is the transparency that's defined our representation goals and our efforts to close our gender pay gap. It's also part of our sustainability agenda and our commitment to net zero emissions by 2050, which I announced on my first day as CEO, because helping our clients transition to a low carbon economy is going to be central to this work. I'm determined for Citi to continue leading on these issues. They're central to our mission of enabling growth and progress. And I thank you again for the opportunity to talk about Citi's efforts to be part of the solution and the recovery to this pandemic. Thank you very much.
Thank you, Ms. Fraser. Next, we will go to Mr. Gorman. You are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, thank you for having me here again today. I'm also an immigrant coming from Australia, and let me tell you, it's a long journey from Melbourne to New York, and I'm very proud that I made it, and I'm now a citizen of this great country. When we were last here in 2019, none of us could have predicted the extraordinary public health crisis that would unfold around the world. We remain in the midst of the crisis that has caused serious humanitarian and economic issues, leaving an indelible mark on many of us. Our hearts go out to all of those directly and indirectly impacted by this crisis. In response to these extraordinary and challenging times, we were focused on serving our clients and our communities and taking care of our employees. We helped our corporate and institutional clients raise additional liquidity and obtain financing. We raised over $50 billion of capital for the industry sectors most affected by COVID, the airlines, the cruise ships, the travel industry. Our teams also helped raise healthcare capital for both Moderna and Pfizer, including a sustainable bond issuance by Pfizer to support patient access to medicines and vaccines, especially among underserved populations. For our retail clients, we guided them to manage their investment portfolios amidst extreme volatility. Today's Morgan Stanley, through its 3 businesses, provides a stable foundation of support in any market environment. In our institutional business, we're a financial advisor to companies. We help them raise debt and equity capital, from taking companies public to helping them issue bonds so they can grow and create jobs. We help public sector entities raise municipal financing. We help pension funds, mutual funds, and other financial institutions trade and manage assets. In our other 2 businesses, wealth and asset management, we manage over $5.6 trillion of assets for households and institutions, including endowments, pension funds that manage the retirements of our teachers, firefighters, and other public service employees. For millions of US households, our services help families save money, whether that be for college payments, retirement, or to put a down payment on their mortgages. Beyond our day-to-day core businesses, we also support the more vulnerable in our communities through philanthropic and employee engagement. A number of well-publicized events last year led to a heightened and necessary focus on racial and social justice, and a recognition that explicit support and purposeful collective action will be required. Some of our efforts in the last year included providing grants to minority depository institutions to help them bolster their loan loss reserves in the wake of the pandemic, and to assist minority and women-owned businesses to ensure an equitable recovery. We started a program to provide 60 students with full 4-year scholarships to Howard University, Morehouse College, and Spelman College, 3 of America's leading historically Black colleges and universities. In addition, we're concerned, like everyone, with how to deal with climate risk over the next decades, which will have profound socioeconomic effect on our communities. Morgan Stanley recognizes the threat that climate change poses, and we're working with our clients to find ways to mitigate it. Finally, early in the pandemic, we committed to making no reductions in our workforce through 2020 to help our employees navigate this crisis, thereby providing reassurance to 70,000 families in a very difficult time. I'm proud of that commitment and the commitment our employees have shown to their clients. Chairwoman Waters, in your letter dated April 30, 2021, you asked me to provide information on 14 topics. In the spirit of brevity, that information is now included in the attached addendum, and I look forward to your questions.
What's happening?
Madam Chair, your turn.
Can you hear me?
Yes.
Yes.
Thank you very much.
We cannot hear you.
Okay, it keeps changing. Okay, we're back now. I want to thank you, Mr. Gorman. Next, we will go to Mr. Moynihan. You are now recognized for 5 minutes to your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and distinguished committee members. At Bank of America, we serve 1 in 2 American households, and my 200,000 plus teammates and I take that responsibility very seriously. Our incredible team interacts with clients tens of millions of times a day. We do so through our 4,300 financial centers, 1/3 of which are located in LMI communities, 17,000 ATMs on the phone, and through our digital capabilities with 40 million active digital users. In 2020, our clients turned to us for support like they hadn't done before. Thanks to years of investment and our focus on responsible growth, our teammates were there to support those in need. And through it all, a growing number of clients have placed their trust in us. Since the start of the healthcare crisis, deposits have increased significantly, and our customer base has grown across all our businesses. We helped our clients and the U.S. economy through the worst economic shock in recent years. For clients in need, we deliver financial assistance through our business as usual work and by helping deliver the timely federal relief programs that you and your colleagues authorized. We helped nearly 2 million consumers and small businesses defer payments on credit cards, vehicle loans, and home loans. Even with a deferral, the vast majority of these clients remain current on their payments, and that is a good thing. We provided PPP loans to nearly 500,000 small businesses. 83% of those loans have gone to businesses with 10 or few employees, and nearly 40% have gone to businesses in majority minority communities. We sent millions of emails to help clients understand the program and encourage them to apply, including target outreach to drive awareness to all communities. Apart from PPP, we remain the largest lender to small business in the United States, according to the FDIC, with $35 billion in small business loan balances, 60% of which is in LMI communities. We also processed more than $73 billion in stimulus paid Congress and took additional steps to help overdrawn clients access their full payment without any offset. The products and services we provide are essential to our clients, to our communities and economy, and we continue to take steps to help our clients' day-to-day financial needs. In 2020, as a complement to our successful Safe Balance No Overdraft checking account, we launched Balance Assist, a low-cost, digital-only alternative to payday-type loans, allowing clients in need to borrow up to $500 for a flat fee with no interest. We also increased investments in our team during the pandemic. We expanded many of our benefits, including support for mental health, free virtual medical consultations, and no-cost coronavirus testing. We offered teammates $100 per day to hire someone to come into their home to take care of their children or their adult dependents. We have funded more than 4 million days of care for our teammates. We implemented coronavirus testing and daily health screening, installed wellness barriers in all our branches. We provided special compensation programs for our teammates, including supplemental pay and enhanced overtime pay, as well as transportation and meal subsidies. And we had no layoffs in 2020. We ensure that all employees are compensated well. Last year, we increased our minimum hourly wage rate of pay for U.S. teammates to $20, 1 year earlier than planned. And we committed to raise that to $25 per hour by 2025. Vendors within the United States also are required to provide wages at or above $15 per hour if they serve us. To date, thousands of vendor employees have benefited by this. Since 2012, we have not increased medical premiums for teammates earning less than $50,000. For 2020, we provided special compensation awards to 97% of our talent team globally, the 4th straight year we've done so. Maintaining our diverse and inclusive workplace also continues to be a priority. 50% of our management team and 50% of our board of directors is diverse. More than half our global workforce is women, and 45% of our US-based teammates are people of color. We hired and trained more than 10,000 employees from LMI communities in the last 3 years alone. Finally, over the past year, we increased our investments to support our communities. In June 2020, we accelerated our long-standing work to promote racial equality and economic opportunity to drive investment in jobs, small business, housing, and healthcare to our local communities. We have committed $1.25 billion over 5 years and have already deployed $350 million of that, including common equity capital investments in 17 MDIs and CDFIs, investments in 90 private equity funds that are both run by minority and women entrepreneurs and also focus on minority and women-owned business, 29 million masks and other PPE to underserved communities and community centers. We increased our homeownership assistance program to raise the goal from $5 billion to $15 billion. We also accelerating the transition to a low carbon economy. We are committed at Bank of America to achieve net zero greenhouse emissions before 2050. We are working alongside and supporting our clients in every industry to help make that transition. We at Bank of America believe in capitalism and believe it's the best way to solve the changes facing society. We can deliver for our shareholders and for society. We call that responsible growth, and thank you.
Thank you very much, Mr. Moynihan. Now we will go to Mr. Scharf. You are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, members of the committee, good afternoon, and thank you for the opportunity to be here today. Just over a year ago, I appeared before this committee upon assuming my role as CEO. We were on the verge of a global pandemic, and I cannot help but look back and think how little we understood of what 2020 would bring. When the pandemic struck, we all came together to stand up unprecedented assistance at a scale and speed that had never been done before. Though the process was not perfect, we, the government, and others rallied to do what needed to be done. And now we must continue to work together to ensure a fair and equitable recovery. As we begin taking steps towards recovery, I'm proud of Wells Fargo's efforts to support our customers, our employees, and the communities we serve, all while continuing to transform our organization. I believe our countries and communities benefit from a strong Wells Fargo. I'm proud that we've been a source of strength for our customers and communities during the toughest of times. They are our core and must remain our priority in all we do. To support our customers during the pandemic, we deferred payments and waived fees for more than 3.7 million consumer and small business accounts to help people to make ends meet. We provided over 1 million mortgage forbearances and suspended residential property foreclosures and evictions to keep Americans in their homes. And we acted as a leading lender in the Paycheck Protection Program, funding more than $13.7 billion in aid to small businesses. Over 40% of our loans were made to businesses located in low to moderate income or majority minority census tracts. Recognizing that the goal of the PPP was to provide a lifeline to struggling small businesses, we also took more than the $400 million in fees generated by the program in 2020 and are donating them to our Open for Business Fund, which is allowing us to engage CDFIs, not-for-profits, and others to help businesses manage the economic effects of COVID-19. And we will continue to do our part by working on solutions to tackle the problem of underbanked individuals and other efforts to foster an inclusive recovery. We look forward to defeating the impact of the pandemic together and believe Wells Fargo will play an important role to helping rebuild a stronger America. To our employees, I'm proud of the work you've done over the past year to support our customers and communities during these uncertain times. We've prioritized safety and well-being, and my deepest gratitude goes out to our frontline workers who made it possible to keep branches safely open. We transitioned more than 200,000 employees to remote work last March, and we understood the tremendous strain the pandemic would place on all of our employees and the families. We made special cash awards to approximately 165,000 employees, offered enhanced support for employees who are parents or caregivers, provided free voluntary COVID-19 testing for all employees working in a Wells Fargo location, and offered paid time off to employees. We offer paid time off to employees for vaccination appointments. For the communities we serve, we continued to invest in the institutions critical to their success. While we're very encouraged to be seeing signs of improvement, we realize that not all of our communities are benefiting equally in the recovery. That is why Wells Fargo has been working to support a more inclusive economic recovery with a focus on racial and social equity, economic mobility, and investments in low to moderate income communities. For example, we're investing in Black-owned minority deposit institutions across the country as part of our $50 million commitment to support MDIs. And we've given more than $150 million to CDFIs around the country. We're providing grants to hard-hit small businesses. Additionally, last week, we announced our Banking Inclusion Initiative, a 10-year commitment to accelerate unbanked individuals' access to affordable mainstream accounts and helped unbanked communities have easier access to low-cost banking. We are also committed to helping transition to a low and have set a goal of achieving net zero greenhouse gas emissions, including our financed emissions by 2050. And finally, for our company, while we still have significant work to do, we are committed to devoting the resources necessary to operate with strong business practices and controls, maintain the highest levels of integrity, and have an appropriate culture in place. Thank you again for having me, and I look forward to answering your questions.
Thank you very much. Thank you very much, Mr. Scharf. Finally, we will go to Mr. Solomon. You are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairman Waters, Ranking Member McHenry, and members of the committee. Thank you for giving me the opportunity to speak today. These last 14 months have been an incredibly challenging time as the pandemic has swept across the world, killing almost 600,000 Americans and plunging us into a steep economic retraction. Even today, our hearts go out to the people of India and others around the world who continue to suffer from this virus. However, because of the swift actions taken by Congress, the Federal Reserve, and others to combat this health and economic crisis, I am optimistic about our future. As more people are vaccinated, the U.S. is poised for a very strong recovery. And I'd be remiss if I didn't thank Moderna, Pfizer, Johnson & Johnson, and AstraZeneca for the amazing work they and others have done on life-saving vaccines. The banking industry performed well during this crisis, as the Fed's 2 stress tests in 2020 confirmed. This is due in part to the Dodd-Frank Act and other financial regulations put in place since the 2008 crisis. Goldman Sachs remained well capitalized both leading up to and throughout the pandemic. Goldman Sachs has more than 40,000 employees, and I continue to be in awe of their resilience. To help them through the pandemic, we gave people an additional 10 days of paid family leave, expanded access to child and adult care, offered free telemedicine, and rolled out a global COVID testing regime. In addition, we've continued to pay our on-site vendor staff whether they worked or not. That includes our mailroom staff, cafeteria workers, security guards, and janitorial staff. Over the last year, we experienced historically elevated levels of client demand. And because we were well capitalized, we were able to help our corporate clients weather the impact of COVID-19 and position themselves for a post-pandemic recovery. For our digital bank customers, we launched a COVID Customer Assistance Program, which allowed customers to defer loan payments for 4 months and credit card payments for 6 months at no additional cost. We also found innovative ways to support small businesses. We are not an SBA lender, so we did not participate directly in the Paycheck Protection Program. Instead, we committed $1.25 billion in capital to community development, financial institutions, and mission-driven lenders who facilitated PPP loans across the country. The capital we deployed with our CDFI partners reached very small businesses, nearly half of which are in minority communities. The average loan size is around $43,000, and the median employee count is 2. In addition, last week, we committed another $1 billion in partnership with the SBA and our CDFI partner, Lendistry, to fund approximately 40,000 PPP loans, over half of which will benefit minority-owned businesses. We did this to ensure these applicants were able to have their loans processed and approved before the PPP funds were exhausted. We also continue to support small businesses through our 10,000 Small Businesses program, launched in 2010. Through this program, we provide education by partnering with community colleges and greater access to capital to thousands of small businesses. Last year, we committed an additional $250 million to serve another 10,000 small business owners. We've also committed an additional $500 million to our program for diverse entrepreneurs, launched with GS. I now want to focus on 3 other initiatives that are incredibly important to us. First, we've already achieved more than a fifth of our 10-year target of $750 billion in financing, investing, and advisory activity focused on climate transition and inclusive growth. We've been carbon neutral across our operations since 2015, and we recently set a goal of net zero carbon emissions in our supply chain by 2030. Second, we commissioned extensive research on how to mitigate income inequality which showed that Black women are one of the most marginalized groups in this country. It found that if we can reduce the earnings gap for Black women, we could see US GDP increase by $300 billion a year. In response, we developed a new initiative called 1 Million Black Women, where we will invest $10 billion over the next 10 years to narrow opportunity gaps for at least 1 million Black women in the US. The final initiative relates to our diversity and inclusion. When I became CEO 2.5 years ago, I said this would be a top priority. Since I last testified before Congress, we have made progress. Our board will now have 6 out of 13 directors who are women and will be 62% diverse by race, gender, or sexual orientation. Our newest partner class includes the highest percentage of women and Black partners in our history. In addition, our 2020 campus analyst class in the Americas was 55% women and 11% Black talent, our highest ever. However, I'm not satisfied where we are, and we continue to work to address this. Thank you. I'd be happy to answer any questions you have.
Thank you very much, Mr. Solomon. I now recognize myself for 5 minutes for questions. I'm going to go to a question that I had not anticipated at this point because I wanted to talk about these low-cost homes. But let me just ask, we have, supported forbearance, and some of you certainly have been very good at doing that. However, we're getting a lot of concerns about homeowners, many of whom have lived in their homes for 15 and 20 years. And because of the pandemic, they found themselves with difficulty. They were laid off from their jobs, the jobs closed down, whatever. They could not afford to pay their mortgages in the same way that they had been doing for many, many years. And we had forbearance in the CARES Act, I believe, and also in the American Relief Plan. Now that foreclosure moratorium ends around June 30th for those who have been into forbearance. I want to know from each of you, how many of you are going to offer these homeowners an opportunity for loan modifications, real loan modifications? Even if they don't know about them, are you going to initiate them? Are you going to deal with them in ways that will help save their homes and avoid foreclosure? Let me start right out with Jamie Dimon.
Yes.
Can you tell me whether or not you are going to employ the kind of operation that we won't have to get into a confrontation about, that we don't have to try and do something in law? You are going to initiate this program.
Well, I can't promise you that because I don't know the details, but we don't like foreclosing on people. We give modifications. We have plans. We'll work with everyone, and where appropriate, we will not be foreclosing on people. I do want to point out there are some appropriate where the homes are vacant, the people have been paying for years, they're vacation homes, they're second homes. So where appropriate, you can expect us to bend over backwards to help those folks stay in their homes.
Thank you very much, Mr. Dimon. I described the kind of homeowner that would be looking for a loan modification. I didn't talk about any houses that were boarded up and no one was there and all of that. I took an opportunity to describe that. I'm going to hold you to it. Let me go on to Ms. Fraser.
Thank you very much, Chairwoman Waters. We no longer service our own mortgages. We do so with with partners now. We require that they follow GSE and federal guidelines on these matters, and we only work with people that have good best practices in these matters.
Okay, so you're going to be offering loan modifications. People don't have to, not know about them. You will be offering them. Is that right?
We will be ensuring that our partners provide that. Yes.
Okay, thank you, Mr. Moynihan.
Chairwoman Waters, we have already modified a bunch of these loans, and the good news is a lot of them also have paid off through normal things. A lot of them come current. So yes, we'll continue to modify them because, as Mr. Dimon said, the last thing we like to do is to take someone who can pay us through foreclosure.
Okay, thank you. I don't have time to continue on that line of questioning because I want to talk about not only the fact that the cost of housing is just escalating so much in my own state of California. It's increased probably about 20%. And so it's very difficult for people to be able to get these down payments, et cetera, et cetera. But I want to ask you about these low-cost housing, that's under $100,000 in some of these areas all across the country, small towns and communities of color in particular. They can't get loans from your banks, they tell me. I ask you to submit some information on that. Most of you did, but how many of you are absolutely committed to taking a look at this market and understanding that this is a way by which people in low-cost housing can become owners if, in fact, they can get the loans from you? I'll go back to Mr. Dimon again.
You raised a very good point with us ago, and we are going to dig deep into it and see if we can come up with programs that work.
Ms. Fraser?
Exactly the same, Chairwoman Waters.
Okay, Moynihan?
Chairwoman Waters, yes, we are going to take a look at it. You raised a good point. And as we enter some markets with lower cost housing, we probably will be doing more of them anyway.
Mr. Sheriff?
Chairwoman Waters, we do a significant amount of loans under 100,000. We will absolutely look to see if we can do more.
Okay, and I suppose Gorman?
It's not really a business, Chairman Waters, that we're in. We only did 7 loans this year of that size.
Okay. All right, thank you. My time has expired, and I can't get into this any deeper, and I yield back the balance of my time, and I will now call on our ranking member. You have 5 minutes.
Thank you, Madam Chair, and I want to thank you all for being here in this format. And as I open, this is a sequel that no one asked for. The hearing 2 years ago, I don't know that much was learned. We're going to have a similar issue set, but modified by the political discourse of the day. And so, I think of this as an opportunity for me to ask you important questions about your insight into the economy. We know that through the financial crisis, the banking sector it provided important liquidity and played its role in our economy to ensure that that lending was possible, that smart underwriting and lending was still possible in the midst of a pandemic. So I think that is commendable work that your institutions and banks and fintechs and credit unions put in during the financial crisis. The question I have for the whole panel is to have the outlook on jobs going forward. We had 8 million unfilled jobs last month. 8 million unfilled jobs. We had 266,000 net increase in employment, but 8 million jobs unfilled. There's a lot of debate in Washington about why that's happening. I'd like to hear from you as experts on the economy about the nature of that. So if we can begin with you, Mr. Scharf, and then you, Mr. Moynihan.
Congressman, I'm not sure I have a great answer as to why it's the case. What I can tell you is what we hear from our clients and what we see ourselves. And what we see from our clients is that their confidence is building. And they feel very, very good about the prospects for the second half of the year. Debt levels are down on a corporate basis.
But how can you have economic growth if you can't get people to go back to work? That's the fundamental question. Let me move on to you, Mr. Moynihan. Same question.
Our small business customers, we just completed a survey, and that the issue raised has come up to the highest level of all the issues. It was a pandemic, obviously, 6 months ago, and now it's turned to getting workers for the jobs. I think it's a serious concern, and I think that the states and others I talk to are trying to put money to work to train people, and I agree with you. It's if you think forward about the risk of the economy, it's the inability to get stuff in through the ports, and it's the ability to get people to work back to work in a fashion now that the economy is opening up.
Ms. Fraser and Mr. Dimon.
Yes, I think we're seeing significant dislocations as the economy normalizes. One of the pieces that will be critical is as the savings go back to work and as liquidity that is sitting out there at the moment gets translated into ways that create more employment and new business creation to drive the recovery.
Mr.
I think, Ranking Member, I think the reasons are manyfold, including some of the unemployment insurance, including the fact that our schools haven't reopened up, and including the fact that people actually have a lot of money and they don't particularly feel like going back to work. But I think you should rest assured, I think we're going to see a completely booming economy. A lot of people are going back to work, and hopefully it will continue for quite a while.
Well, thank you. Thank you for answering that, Seth. Now I've got questions about on the international front. We see a lack of transparency associated with China's lending across the globe. China's resisted international standards set by bodies such as the Paris Club and the OECD arrangement on officially supported export credits. We see this globally. Moreover, we see the Federal Reserve has flagged elevated debt levels in China, high real estate valuations, and weaknesses in their financial sector. And what I see is a lack of transparency in their lending and a lack of transparency internationally to their domestic actions. Can you give me further insight into this, and how can how should we believe China? And do you believe that China's lack of transparency and its official financial sector vulnerabilities pose a potential risk to global financial stability? Mr. Solomon, that question is for you. Then to you, Mr. Dimon.
I appreciate the question, Ranking Member McHenry, and I think you phrased a bunch of issues that are issues that we spend a lot of time thinking about. Transparency in markets is always extremely important, and more transparency is better. I think that we understand that we operate in a very globally interconnected market, so the degree that some of the issues you highlight do become issues that have an impact on China's economic activity, we'll certainly feel it back here in the United States, and it can have a contagion effect. I don't see that at the moment as a likely issue, given the recovery they've had coming out of their pandemic, but I think all these things are things that should be watched and observed closely.
The gentleman's
Well, Mr.
time
Dimon, I think you were saved by the bell, and thank you all for testifying.
The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, for holding this hearing and standing up for consumers, and thank you to the panel for participating. I want to follow up on the questions from Senator Warren about overdraft fees. President Obama signed into law my Credit Card Act, the bill I wrote to end the most abusive practices of the credit card industry. According to one study, this bill alone is estimated to have saved consumers nearly $12 billion a year. A 2015 CFPB study estimated that it saved consumers $16 billion in the first years of its enactment. But where we made great progress on stopping abusive practices in the credit card market, there is still much work to do on banks' overdraft practices. I plan to soon reintroduce my legislation, the Overdraft Protection Act, to crack down on unfair predatory overdraft fees. Bank overdraft fees are outrageously priced, predatory, and beyond the scale of what a reasonable charge should be for this service. And we know that these fees and practices are harming consumers and taking billions out of their pockets. According to an S&P Global Market article from earlier this year, the larger banks collected $8.8 billion in overdraft fees alone and reported over $147 billion in net income in 2020. Making these practices even more egregious, overdraft fees hit those who can afford them the least, the hardest. Those who are trapped are often cash-strapped, hardworking Americans and college students who are struggling to pay their bills. And so that $8.8 billion collected last year is money taken out of the hands of Americans who are trying to just keep food on the table and stay afloat in the middle of our pandemic. Each bank has slightly different policies, making this even more confusing to consumers. All of your banks basically charge around $35 for each overdraft. But the worst of these fees can be on debit card transactions, where the overdraft averages $20 but comes with a $35 fee. Multiple transactions can quickly add up to where a consumer is charged well over $100 in fees alone. So let's focus on Wells Fargo. Mr. Scharf, neither Citi nor Bank of America charge overdraft fees on debit card transactions, apparently deciding this practice was not in the best interest of their customers. I find it curious, why has your bank made the opposite decision, seemingly thinking a sandwich or a cup of coffee at a deli should result in a $35 overdraft fee if they can't afford it?
I'm sorry, are you finished?
I'm waiting for your answer.
Congresswoman, we are constantly looking at ways to be more consumer friendly. We introduced an account last year which has no overdraft fees at all. It's actually probably our most popular account since we've introduced it. And so we have options that are readily available for customers who do not want to overdraft. We also offer overdraft protection and something called overdraft rewind for those that aren't account that can overdraft, which allows us to look back 24 hours for a direct deposit coming into that account. And so these are things that we've added where we're looking to become more consumer friendly, but it's certainly something that we will continue to look at.
Well, when did you introduce you have an account that has no overdraft fees?
We
I
introduced
would think that everybody would take that one because I don't think many people want to pay $35 overdraft fee for a cup of coffee. When did you introduce the program that has no overdraft fees?
We announced it approximately a year ago, and I believe we've had it in the market for probably 6 months or so. I'll get you the specific dates.
And how do you inform your customers that they can have this option of not having any overdraft fees?
It's part of the suite of products that we talk to our customers about on a very regular basis.
Well, it seems like I would think everyone would choose that if that was really possible. I think everyone likes a good sandwich and a cup of coffee, but not at a cost of $40 or $50. And I feel that these fees are unfair, unaffordable, and unreasonable for all Americans, plain and simple. Let me ask you, Mr. Scharf, do you think a $35 fee for a $6 debit charge is reasonable?
The gentle lady's time has expired. Would you please get back to Ms. Maloney to answer that question? With that, we're going to go on to Ms. Wagner from Missouri. You're recognized for 5 minutes.
I thank you, Madam Chairwoman. And I'd like to also thank our witnesses for being with us today. It is important to me that public companies, such as the ones that you all lead, continue to focus less on political agendas and more on what will benefit your investors, your customers, and your workers the most. That is maximizing profits and shareholder value. I'd just like to say that up front. Mr. Moynihan and Mr. Dimon, this is for you. The Biden administration has proposed an increase in the tax rate as high as 28% for American businesses and industry, along with many other tax increase measures, all to offset an additional anywhere from $1.7 to $2.3 trillion in government spending. How would an increased rate impact your ability to support our economic recovery, and what sort of burden would American workers and small businesses bear? I'll start with Mr. Moynihan's response first.
For the question, I think starting with your point about what our customers tell us, our small and medium-sized businesses, of which we have many, are worried about tax increases, not slowing down their ability to invest in employees, invest in new equipment, be competitive, because many of those small businesses supply into the supply chain for the larger companies in this country. And so their concern is about that. When you go to the larger companies, an increase in taxes is a couple things. One is their fear is that it'll lead them to have to put more capital available outside the United States because frankly, the final demand, the globalization economy provides opportunities that weren't here 30 years ago. And I think they're concerned about that. They're also concerned about the impact of prices coming into them from suppliers. So I think that's what's on the minds of our customers, and I know that there's a lot of work going on in this body and other bodies regarding the merits of all that, but that's what we hear from our customers.
Thank you. I appreciate it. Mr. Dimon, briefly.
Yeah, so the Biden tax number has taxed 21% to 28, which is halfway back to what we think we had in 2017 before the last tax act at 35. But the tax increase is actually 4 times what the tax decrease was from 2017. Because you all know the phrase, devil the details. Well, the details here are all that matter, not the top line of 28%. I've always believed that we need, if you want to have a healthy, growing, competitive America against the rest of the world, you need a global competitive tax rate, because at the margin, capital will be retained and invested overseas. The same capital you want retained and invested over here. So I think it would be detrimental to a lot of, I'm not worried about banks per se. It'll be detrimental to a lot of companies. It will push a lot of capital overseas. It'll be unfortunate. There are better ways to collect taxes that would do less than that.
And it would hurt the customers and the clients that you serve every single day. And
That's
we
right.
must also remember that 55% of small businesses organized as a C Corp. So real quickly, one answer fast. Would an increased rate allow your firms to be more or less competitive globally? Mr. Moynihan, more or less competitive?
I'm sorry. An increased rate could lead to less competitiveness globally. Thanks.
Mr. Dimon.
It would be less competitive, and they'll get increasingly worse over time.
Thank you. Mr. Dimon and Ms. Fraser, would you describe the challenges your firm faces in terms of global competition? Specifically, how does China factor into those challenges as a global competitor? I'll start with Ms. Fraser's response, please.
Oh, thank you very much. China is playing an increasing role in the global financial system. And I think it's very important that for serving American multinationals abroad and indeed the US government and other entities that the important flows of foreign exchange, trade, cash management, and indeed the access of global investors, the US market happens on American rails and not on another countries. I think it's of strategic importance for our multinational companies and those working abroad.
Mr. Solomon and Mr. Gorman, discussions around a financial tax transaction tax have increased over the last several months. I'm concerned about the harm that this tax would do to our Main Street investors saving for college or retirement. What adverse effects would this type of tax create within our financial system? Mr. Solomon, and I have very limited time.
It impacts investors, and it would impact investor activities, Congresswoman.
If I could, Madam Chairman, I've run out of time. I would ask for Mr. Solomon and Mr. Gorman to send me a written response, if they wouldn't mind, to the concept of this financial transaction tax. And I thank you, and I yield back.
Thank you very much. The gentlewoman from New York, Ms. Velazquez, who is also the chair of the House Committee on Small Businesses, now recognized for 5 minutes.
Thank you, Madam Chairwoman. Mr. Dimon, I would like to address my first question to you. In addition to being a senior member of this committee, as mentioned by the chair, I am also the chair of the House Small Business Committee, which has primary jurisdiction over the Paycheck Protection Program. Despite making several changes to the program between the first tranche and the second tranche, to make it easier for LMI small businesses to access funding, and including a specific set aside for borrowers located in LMI areas. The number of PPP loans issued by JPMorgan community in LMI communities actually decreased. In round one, your bank issued approximately 58,000 loans to LMI small businesses, while in round two, you only issue approximately 14,000. Can you explain this decrease?
Well, we're the largest lender in PPP. We lent as much as we can, everywhere we can, according to government guidelines. 90% of the loans in the first round went to companies of less than 20 employees, and we reached out everywhere to LMI communities and stuff like that. I'll get the exact numbers, but I think we did a fairly good job at it. And
well, I do have the numbers. I do have the
well,
numbers. I do
second
have
program
the
is much
data
smaller
because
than
I'm
the
the
first
chair of the Small Business Committee and working with the SBA. In fact, we held a hearing yesterday. So my question to you is, when we're talking here, that despite the fact that we set aside for just lending to LMI small businesses, not only did your bank decreased the number compared to the first tranche and the second tranche, but also the size of those loans. It went down from approximately 117,000 in round one to 80,000 in round two. At the exact time, we all knew that small businesses in LMI communities were starving for capital. And despite how hard they work at applying for those loans. So it doesn't seem to me that your bank was doing everything it could to reach these businesses.
Well, we did, and we reached out everywhere we can. There was less demand. The second program was smaller, and then we went out in other ways too. We lent $70 million. We invested $70 million in MDIs. We invested in some of the Latinx banks. We reached out to CDFIs. We begged them to help us find more people. So we did everything we can reasonably do, and we always try to do the best we can.
Well, sir, the numbers showed otherwise. And those numbers change in LMI communities when we work and brought in mission-based lenders such as CDFI, CDCs, micro lenders. So I hope that we can do a better job in reaching out to those businesses that are starving to get access to capital. Ms. Fraser, when we held this hearing 2 years ago, I questioned your predecessor on Citigroup's CEO pay ratio, which was the largest of any bank testifying that day, a remarkable 486 to 1 ratio. Can you explain how you're working to reduce this ratio? And in your explanation, can you discuss not only the CEO side of the equation, but the median employee compensation side as well? Ms. Fraser?
Can't hear you, Jane.
Sorry, my apologies. Thank you very much for the question. Yes, I want to start by saying we completely appreciate how fortunate I am for the compensation that I do get as the new CEO at Citi. We want to make sure that our employees have a fair, competitive wage, that they have the opportunity to grow inside our company, provide them development opportunities, and also to provide them the different benefits that they need to support their families and for all the challenges during COVID and beyond. So the different things that we're looking at are the programs that we can put in place to support our employees' growth in their compensation going forward.
I yield back, Madam Chair.
Thank you very much. The gentlelady's time has expired. The gentleman from Missouri, Mr. Luetkemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair. As the largest financial institutions in the country, you extended $8.3 trillion in credit last year, which is a testament to your ability to advance our economy. I'm very thankful for that, quite frankly. However, when you all decide to boycott industries, you use your size and power to put companies out of business. What's worse is that these decisions clearly are not made as a matter of conscience. Your investments in China prove that. These decisions are being made to pacify political activists who want to do what the law cannot do, which is shut down legal American businesses. By complying, you are no longer supporting our economy, but actively working against it, I would argue. To that end, there's a report out that all of you have put out, the Environmental, Social, and Governance Report, where you publicly proclaim the actions of your banks in these different areas. 5 of the 6 reports that your institution specifically mentioned moving away from coal financing and investing in other things. There's an article just recently that came out in Bloomberg titled, Goldman, Citi lead U.S. banks plowing billions into China. specifically JP and Citi 21 billion, Goldman 17 billion, B of A 13, Morgan Stanley and Wells Fargo 4. To that end, it's worth noting that the ESG reports condemning the coal industry, only Goldman mentioned China in terms of carbon emissions. Ms. Fraser, quick question for you. Is coal and drilling for oil and gas, is that illegal?
No, it's not illegal.
Are you taking similar actions in China to what you're doing here in the United States by boycotting specific industries and putting pressure on companies to change their business model?
We are supporting the clients that we serve, multinationals and local companies, to make the transition to lower carbon technologies, mindful that different industries are at different stages of doing so.
So you're probably not, is that what you're telling me?
Correct.
Okay, Mr. Gorman, Morgan Stanley, they've got about 4 billion. Same question, is mining coal and drilling for oil and gas, is that illegal?
No, it's not.
Are you taking similar action in China that you're doing here with boycotting specific industries and putting pressure on companies to change their business model?
We're continuing to support existing coal businesses around the world. We're not financing new coal businesses in any country in the world. It all goes to our franchise committee.
Thank you for that. In addition to the ESG reports, each of your institutions have published statements on human rights which include actions your companies are taking to improve human rights around the globe. I want to point out that not one of your statements on human rights mentioned China. Not one single company mentioned China in your human rights statement. The State Department has a statement out with regards to what's going on in China. It's widely reported the kind of religious genocide that's going on, the horrible torture and other things that are going on with minority religious groups over there. And now even the administration in the last couple of days has acknowledged that the development of the COVID virus at Wuhan Labs is going to go after that, which is done obviously for nefarious purposes. Mr. Solomon, you've been in China since 1994, have a 17 billion in investments there. Do you intend to alter your business in China as a result of these human rights violations?
Well, first and foremost, Congressman, I appreciate the question. And first and foremost, we're an American company, but we operate on a global basis. I think the bilateral relationship between the U.S. and China is incredibly complex. There are places where obviously we cooperate, and there are places where we're confrontational. We try to navigate that in an appropriate way and stay engaged with our clients around the globe.
So is the lure of profits that great that you will turn your eye to the human tragedies and sufferings that are going on in China by their government and the Communist Party, which is one and the same, which is who you deal with for the last almost 30 years here?
We, I think, look at this broadly as a complex relationship. I saw recently that Secretary of State Blinken said that we have to at all times be competitive, collaborative, and adversarial. We try to operate our clients, our U.S. companies that we serve, congressmen, are operating in China, and we try to serve them in that context. We think it's better to stay engaged than not, but we'll follow very closely what you all do as legislators in terms of how U.S. companies should be engaged around the world, and we take that very seriously.
Mr. Dimon, would you like to answer the same question? Do you intend to alter your business in China because of these human atrocities that's going on?
So we operate in over 100 countries, and we operate under the law of the land in each of those countries, and under the law of the land is the Communist Party law. But we follow the foreign policy of the United States of America, which is your policy. So we follow engagement.
Foreign policy in this country.
And when you tell us not to, we don't. Like Cuba, how we do business in Russia, we follow exactly what you tell us to do because we're patriots, just like the rest of you in this call.
Well, I think the previous administration getting out of China, cutting trade ties, and getting the trade deficit down. Thank you very much. I yield back.
The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
In 2008, the financial system caused a horrendous crisis that devastated our country. Democrats responded, changing the regulatory system, particularly Dodd-Frank. Now the financial system has survived the greatest stress test that I could have imagined. It did not cause this crisis, and it has shown resiliency during this crisis. That's in part because of the regulatory changes that we made, and in part because of the stewardship of some of the executives that are before us today. We now face another systemic crisis. It's certainly not of the same level of COVID, and that is LIBOR. We can solve this in advance and avoid the problem. My colleagues have heard me talk about this again and again. We have several $1 trillion of instruments outstanding, where next year or into the following year, you will not be able to calculate the amount of interest that is due because they're tied to the LIBOR rate that the folks in London will no longer publish. So I'll ask each of you, and I'm going to ask you to answer in one word. Do you feel that federal legislation is warranted to deal with the financial and legal fallout that will occur if we don't have a replacement rate for LIBOR? Mr. Dimon.
Yes.
Ms. Fraser.
Absolutely, yes.
Mr. Gorman.
Yes.
Mr. Moynihan.
Yes.
Mr. Scharf.
Yes.
Mr. Solomon.
Yes.
Thank you. Mr. Solomon, Archegos put a light on total default swaps in family offices. We haven't had in this country a limitation on margin lending. You have to put up half the money, and that has been the rule basically my entire long lifetime. But we saw the Archegos family office get 9-to-1 leverage by using the total return swap. And so my question is, should we allow the average Robinhood investor to get 9-to-1 leverage? Should we prevent Archegos and the other well-connected and wealthy institutions from getting more than 1-to-1 leverage by banning the total return swap and similar devices? Or should we have one rule for Robinhood and another rule for the Sheriff of Nottingham and his family office?
So I appreciate the question, Congressman, and I think that this is an area that I know people are looking at closely, and I think it's probably a good thing to continue to look at it. I think the big thing I'd focus on is transparency. And I think one of the things that would be interesting is to update the disclosure regime around the different and more modern ownership exposure.
I asked a question. It's now very transparent. If you're a Robinhood customer, you get 1-to-1 leverage. If you can negotiate a total default swap, because you're big, you can get 8-to-1, 9-to-1 leverage. That's transparent. The question I asked you is, should we stop it? And your response has been, well, we should disclose it. My question is, should we have the same rule for Robinhood as the Sheriff of Nottingham in his family office?
I think when you look at institutional participants in markets, there are a variety of ways where people can get leverage that's more than 1-to-1. Generally for just straight stock ownership, straight up cash stock ownership, whether retail or institutional, if you're looking at straight margin, Reg T margin rules, it is 1-to-1. Generally speaking,
obviously, reclaiming my time, the total default swap is a way to have all the economic benefits of stock ownership and evade the rules. I'm going to try to squeeze in one more question for Mr. Scharf, and that is, we see that $1 trillion of federal taxes go unpaid by the top 1%. President Biden has indicated, along with his Treasury Secretary, that to collect that, we need more reports from banks. If those are legally required, are you prepared to cooperate and not only disclosing the taxable income, but the transactions required?
Congressman, we will do whatever is legally required.
Thank you.
Thank you very much. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. 40 years ago, as a young man, I was trying to get into the farming business, and I went through the inflationary period in the late 70s and early 80s. Very exposed, operating in debt, interest rate controls had gone off. It was a wild ride. So that brings me to where we are 40 years later. Over the past several months, we've experienced a surge in commodity prices: crude oil, natural gas, corn, soybeans, wheat, materials like lumber and cotton. What do you believe has been driving this rise in prices, and do you expect this to be sustained for some time to come? And I'd first like to turn to Mr. Solomon and Mr. Gorman to weigh on this, if you would please.
Thank you, Congressman. I appreciate the question. It's certainly something that we've been spending a meaningful amount of time thinking about. I think there are a number of factors that have been affecting commodity prices, and I think as you stand back and look, the shutdown of the pandemic and the dramatic contraction of the economy had a profound contracting effect, and now we're opening up very quickly. And so we have the combination of demand picking up very quickly and supply production and availability and supply chains and distribution chains not being as full as they would normally be. That's obviously leading to inflation in prices. I think what's hard to see at this point is whether or not it's going to be transitory or whether or not it will continue or be more sustained. I do think it's something to watch very carefully, and the speed of the recovery combined with other fiscal actions or monetary actions we take will obviously have an impact on this. Hopefully the Fed can manage appropriately as we go forward in what's obviously going to be a strong economic pickup from a demand perspective.
Mr. Solomon?
Representative Lucas, thank you also for the question. And coming from a long line of farmers from the outback in Australia, where wheat and sheep were the family product, a lot of sympathy for the space. Commodity prices are simply a function of supply and demand. We've had interrupted supply, we've had a global recession, and now we're getting extraordinary demand. We've never had this kind of global synchronized growth that we're going through now. So you're gonna see surges in prices, but as more capacity is brought online, whether it's oil rigs or more mining around the world, you know, these things rebalance. But right now we're in a surge.
I'm just a little nervous, having increased the national debt from 20 trillion a year and a half ago to 28 trillion. That seems like a rather expansive increase in the monetary supply. And as the economy picks up, and what's the term, velocity of circulation increases, I'm just nervous. Anyone under 60 did not live through that period. But when Mr. Volcker decided to bring it out of the economy, it almost wrung a lot of us out of existence. That said, second question. As Congresswoman Wagner discussed, the Biden administration has proposed more than $4 trillion in spending for the American Jobs Plan and the American Families Plan, of which the administration plans to finance with a hike in corporate and individual taxes. The administration's also proposed a global minimum corporate tax rate. While we should level the playing field for U.S. businesses, some argue that global minimal corporate tax rates would be disadvantageous to U.S. companies. Mr. Dimon, could you comment on this concern and how feasible this proposal would be to actually achieve a global tax rate?
Yeah, so America would be the only country, I think, in the world that would have what you would call a global tax rate. I point out that going from 21 to 28 isn't the issue, because people say it's halfway back to what the tax cuts were, but the tax increase because of something like that is actually 4 times the tax cut of 2017. There's no question in my mind that at the margin, not for every decision made, but at the margin, that will drive capital and eventually brains and R&D and investment overseas, and that would be a mistake for America.
Ms. Fraser, could you share your thoughts on how feasible a global minimum corporate tax rate is?
I think it's very hard to get other countries to sign on to an equivalent program, despite some optimism of doing so. I think that will be extremely difficult, and therefore it could put the US in a position of being less competitive around the world.
My background representing an agriculture and an industry, energy industry kind of a district, those international markets are critically important for us, and we've gone through trade wars beyond belief for the last 50 years trying to have fair access and be able to compete. I'm just very sensitive about undoing the progress we've made, just as I'm very sensitive about setting off the Carter era kind of an inflation wave too. Thank you for your comments, and yield back the balance of my time, Madam Chair.
Thank you. Thank you very much. The gentleman from New York, Mr. Meeks, who's also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for having this important hearing. You know, institutional investors are monitoring racial and equity commitments. For example, BlackRock announced in April that they pledged to conduct a racial equity audit to integrate equity and inclusion into all aspects of their business model. Additionally, here in New York State Comptroller announced in February that the state's retirement fund will submit shareholder proposals on conducting racial equity audits, including calling upon Amazon to conduct such an audit. However, many of you seem to disagree with this idea. So let me ask, Mr. Dimon, first, your JPMorgan's proxy statement states that, and I quote, conducting a racial equity audit would not provide us with useful additional information. And Ms. Fraser, similarly, we've heard that the bank reached its shareholders to vote against a similar proposal. So could both Mr. Dimon and Ms. Fraser, could you elaborate on your opposition to independent racial equity audits?
And so I'll start, and you know we're devoted to the principle of trying to do a better job for the Black and Latinx community. We've announced an extraordinary amount of programs that you're welcome to come and look at. And we, from community branches, I just visited one in Harlem, to $30 billion for affordable housing and mortgages for Black folks, for small business enterprise, for getting kids through high school. It's pretty extraordinary. It's pretty global. And I think a lot of the other companies do it too. We're doubling down after the murder of George Floyd. So the company's completely devoted, and we report it out. That is completely different than the bureaucracy and BS of having outside orders come in to certify something. I'd rather take our time and our effort, put it in the effort. If there are best practices that we can learn from, we'll learn from them. But this kind of thing is not going to make it much better over time. It just adds another whole layer of unnecessary cost.
And from the Citi end, we feel we have been very transparent. We just put out another very extensive update on our $1 billion action for racial equity plan, that covers all different dimensions of the bank's activities, both inside the bank and outside, many of which are verified by third parties. So we didn't think it was needed to have a separate audit, but it is something that we're looking at again, given it was brought up by our shareholders.
Yeah, I think it's something, in reply to Mr. Dimon, you say it's not, unless you can verify something with an independent audit. I mean, I've seen in my time here, for example, internal audits, like that's what happened with Exxon. Something that wasn't verifiable, you put in, you get the figures that you want. But if you're having someone come in independently to verify what's going on, then it is something that is trustworthy, not something that may be just in favor of a particular company or financial institution. So I think that independent, and that's why independent audits for various institutions are always important, just as an independent audit on whether or not these commitments are lived up to. But I have just a minute. Let me go to ask them. I'm pleased to hear that many of you have committed significant capital investments towards minority depository institutions. And I've really been encouraging such investments over the past few years, along with Mr. Green and Chairman Waters, and a number of other members on this committee. And I would love to hear more about the implementation, because a commitment to invest is very different from an agreement to invest. And I'll be asking all of you for written responses to this question. But in the meantime, Mr. Scharf and Mr. Moynihan, can you let this committee know whether or not your public commitments to invest in NDIs has or will result in direct agreements with these institutions? Start with Mr. Scharf.
Congressman, we have agreements with 13 Black-owned minority deposit institutions representing $50 million of equity commitments. And that's separate from the commitments that we've made to the CDFIs, where we've committed another $250 million, and we've already given out $150 million of that $250.
Mr. Moynihan?
Congressman Meeks, we have completed, and the money is in common equity for 17 institutions to date, up to 5% based on what they wanted. We've made offers to the other 120 or so that are out there similarly look at investing in them. Many don't need the money and told us they don't want the equity. So we've gone literally institution by institution to make the investments.
I'm out of time. I yield back, Madam Chair.
Thank you very much. The gentleman from Michigan, Mr. Huizenga, is now recognized for 5 minutes.
Thank you, Madam Chair, and to all the participants. I intend to touch on a few issues, but also that my previous colleagues have touched on, but I want to go explore some other things. And to Ms. Fraser, congratulations and welcome to the frying pan. I want to talk a little bit, and I'd like to hear very quickly from each one of you. What do you see as the greatest threat to our financial system right now, and to your company as well, Mr. Moynihan?
Well, as a financial institution, the number one question is what's the economy going to do? Because
economy. Okay. All right. I need it really brief. Ms. Fraser.
Cyber security, given how much of the private infrastructure sits in, or the infrastructure sits in private hands.
Okay. How about Mr. Solomon?
I'd highlight 3 things we focused on: cyber, central clearing risk, growing government debt around the world.
Okay. Mr. Dimon.
Public policy not being properly executed in the United States of America, which means we may not be able to take a leadership role in the world for the rest of our lives.
Okay. What does that mean exactly?
I think we've done public policy not particularly well when it comes to infrastructure, immigration, healthcare, taxation, regulation. We've stifled the formation of small business. American leadership really matters. And if we don't get our academic act together, we won't be a leader in 20 years.
Okay. Mr. Gorman?
Narrow cyber, and specifically the potential impact on consumer data and data privacy.
Mr. Scharf?
Cyber.
Okay. So to paraphrase my friend Mr. Perlmutter in his opening, one of his goals is basically to have safe and sound lending and banking for everyone. I wholeheartedly agree. Now, what's interesting to me, though, is only Mr. Dimon came close to talking about sort of the social issues side of things. Yet all of you have indicated that by 2050, you intend to be at a zero emission scheme within your banking system. Mr. Solomon, I guess you've outdone everybody by saying 2025. And I'm curious, I didn't hear climate in any of that. Closest, again, was Mr. Dimon. But why the hell, why are you spending so much time and effort into this? And Mr. Dimon, you were just expressing why you felt frustrated that you would have to be going through formal audits of these things because it's not necessarily productive. And I'm very concerned about the pressure that you all are receiving as CEOs and as an organization. By the way, I'm curious, I would like to hear from everybody very quickly whether you're banking in Taiwan or not, or are you going to John Cena yourselves in this? So if anybody isn't banking in Taiwan, I'd love to hear you. Any clients that are not in Taiwan, everyone else is in Taiwan, or you do not have any clients in Taiwan?
Congressman, it's Wells Fargo. I don't know the answer to the question, but we can get back to you.
Tell you what, let's reserve that. I'd like to hear back from everybody, because I think that is another pressure point, as one of my other colleagues, Mr. Luetkemeyer, was talking about. But here, all of your firms have pledged fidelity to this whole notion of bowing to the wokeness that's going on environment. And I'm curious, and Madam Chair, I'd like to submit for the record a letter that is from 15 different state treasurers, led by the West Virginia State Treasurer, to former Senator Kerry, Secretary Kerry, the special envoy now, indicating that they are going to be coming back to you, their financial institutions, who they do over $600 billion worth of business. Now, I know in DC we're spending trillions like it's Friday night poker money, but the $600 billion is a significant amount of business for everybody. And I'm curious from everybody, have you seen this letter? And what is your response to that? And basically, they're saying if you are going to limit our ability to have companies in our states in energy sector, in oil, gas, coal, we're not going to do business with you. Are you aware of this letter, and what's your reaction? Mr. Dimon, you're first on my screen.
No, we think the climate's a serious issue.
I understand. Are you aware of the letter?
Yes.
Okay. Is anybody unaware of the letter?
I have not seen the letter.
Okay.
I have not seen the letter either.
All right, we'll ship it over. We'll make sure that that you get that. I know my time is up. I do want to hear about LIBOR and SOFR as well, and I will submit some questions in writing on LIBOR and whether SOFR is the answer for this problem. And I yield back.
Gentleman's time is expired, and your letter is submitted without objection. Thank you. We'll move on. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you, Chair Lady, and I am so excited to be on this panel at this time because we have a major issue here. I want to talk about our unbanked, underbanked, as we apply that to the child tax credit that has been in this, because we have an excellent opportunity here with you all who are the leaders, Mr. Dimon, Ms. Fraser, Mr. Moynihan, Mr. David Sullivan, Mr. Scharf, and Mr. Gorman. You all represent our largest banks. And I want to put this to you. We've just passed the child credit, expanded the Child Tax Credit Act in the 199 trillion COVID relief package. Here's what it does: $3,600 for children under 6, $3,000 for children under 17, and each of the parents are getting guaranteed checks every month. But here's the problem: they cannot do this and receive it with direct payments. And that's what I am concerned about, to help us to make sure that their child tax credit payments can come by way of direct deposits. It's dangerous out there when they don't get it directly. These large series of money every month got to go to a payday lender or somebody on the check cashing service where they got to pay money. So we need to find out what we need to do about this. So Ms. Scharf, let me talk with you, because Wells Fargo has the largest number of branches. And I also checked with our Federal Deposit Insurance Corporation, and let me give you these statistics. 13.8% of Black households are unbanked. 12.2% of Hispanic households are unbanked. But you know what it is for white households? It's less than 2.5%. So it seems to me, my bipartisan colleagues, Reverend Cleaver, myself, and Congressman French Hill from Arkansas has got a bill moving. It's over in the Senate now for financial inclusion. Tell us, if you can, what we must do. 70% of our African Americans live in neighborhoods with no branch bank. So please, Ms. Sharif, you may start. What are you all doing? What can we do? Is there something we can add to our financial inclusion bill? Reverend Cleaver, myself, and Mr. French Hill from Arkansas, I'll be glad to work with you. Ms. Sharif, you got the largest numbers of branch banking. What percentage of yours is in the Black neighborhoods?
Congressman, I share your concern on the issue and also the desire to make changes. And we as an institution are committed to bringing about the change that's necessary to bring more of the individuals that you're talking about into the system.
What would be that change? A move to put more branches available, reach out to community organizations, get these accounts established. It's dangerous.
I think it's a combination of financial education. It's a combination of product design, and it's it's also about having the right kind of facilities and the right kind of partners outside of the big banks themselves to ensure that what we're building is serving the needs of the community.
Mr. Dimon, what about you?
It's financial education. It's us doing a better job reaching out to the community. And like Charlie said, it's working with CDFIs and MDIs to improve that outreach.
All right. What about you, Mr. Solomon?
We have a very, very small consumer business. We have no branches, but I do think at a high level, just commenting generally, the comments that Mr. Dimon and Mr. Scharf made are correct. Financial education, using the network of CDFIs, mission-driven lenders, et cetera, for better reach out.
Well, I hope y'all know we got to solve this problem. We can't leave these people. Many of them are single-headed household, people with disabilities, with no bank accounts. They're out there, and the predators are waiting on them. We got to get their
time has expired.
Thank you.
The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
To our witnesses, thank you for your time today. Each of you or your predecessors signed the Business Roundtable's 2019 restatement of purpose of a corporation, subordinating shareholders to so-called stakeholders. As yesterday's hearing in the Senate Banking Committee demonstrated, this redefinition of a corporate purpose did absolutely nothing to placate or appease Senator Warren or the extreme far left. In fact, it emboldened them. And whether you admit it or not, there are instances where the interests of shareholders and stakeholders come into conflict. For example, in October 2019, Senator Warren wrote a letter to Mr. Dimon stating that because of the restatement, she, quote, expects that you will endorse and wholeheartedly support her Accountable Capitalism Act. The bill would, among other things, require workers comprise 40% of the board and dictate that companies obtain a federal charter to operate. I'll ask each of you to answer yes or no if you could. In an event where there is a direct conflict between the interest of shareholders and non-owner stakeholders, will you prioritize shareholder interests? Mr. Dimon, we'll start with you.
Yes.
Mr. Moynihan.
As I said in my open testimony, we deliver both for shareholders and for society.
When there's a conflict, which one will you prioritize?
We will prioritize the return to the company.
Thank you. Mr. Solomon.
Yes, we'd prioritize shareholders.
Ms. Fraser.
Yes, we will prioritize our investors.
Mr. Scharf.
Yes, our shareholders.
And Mr. Gorman.
Generally, shareholders, there are circumstances where it's a no. Last year, we guaranteed every employee their job as stakeholders. That was obviously to the detriment of shareholders if we hadn't been profitable.
Well, thanks for mostly keeping in mind your fiduciary duty to shareholders. 3 of you signed on to the Net Zero Banking Alliance, while 3 did not. The alliance is part of President Biden, John Kerry, and Bank of England Mark Carney's misguided plan to weaponize the financial system and politicize it to choke off funding to legal fossil energy businesses. Joining the alliance requires your institutions to submit information to the United Nations so they can certify that you're green enough. Mr. Dimon, you did not sign this. Why not?
It was too vague. It's hard to meet the commitments. We've already made a very detailed public statement about what we're going to try to accomplish. We've been working very closely with auto companies and oil companies and utilities to figure out how to do it the right way. We need to do this the right way, and signing statements is not the right way. Over time, there will be better disclosure of what people are trying to get done.
I appreciate, as we discussed, your commitment on this in your shareholder letter as well. Mr. Moynihan, Mr. Dimon says he doesn't need John Kerry, Mark Carney, or environmentalists at the UN to tell him how to manage his risk or run his business. My question to you is, should access to financial services be tied to the creditworthiness of borrowers regardless of politics?
Creditworthiness borrowers is the primary way we underwrite credit, yes, sir.
That's good to hear. Thank you. And I would encourage all of you to prioritize credit risk as opposed to politics. Finally, on fossil energy, does anyone on the panel think it's a good idea to immediately and completely cut off financing to fossil energy? Please raise your hand if you think it's a good idea to immediately cut off financing for fossil. I want to let the record show that none of our panelists believe that that is the case. Unfortunately, some of your financing commitments combined with the administration's desire to, quote, change the allocation of capital in energy are disrupting supply without doing anything about demand. Data published even by the Biden administration concludes that fossil energy will constitute more than 70% of all energy consumption in the United States by 2050. This supply-demand disruption will raise prices for consumers and cede economic competitiveness to countries like China. In 2020, Citi's JPMorgan, Goldman, Bank of America, and Morgan Stanley had a combined $77.8 billion in exposure to China, up 10% from 2019. And yet, China is responsible for more than 27% of total global GHG emissions. Are any of you mandating the same environmental standards in your Chinese investments as you work with American companies to help them with the transition? Anyone can offer your opinion.
Our standards are worldwide.
Our standards are global too.
Our standards are also global.
Ms. Fraser?
It's a global policy, yes. It's the same.
I'm running out of time, but I appreciate that approach. China is by far the leading emitter of global GHG greenhouse gases. There needs to be a uniform policy. If GSIBs are to promote American competitiveness, let's hold China to the same standards we hold American companies. Thank you for your time, and I yield back.
Thank you. The committee will be in recess for 5 minutes. The committee will come to order. The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. Madam Chair, regardless as to what anyone says, you are bending the arc of the moral universe toward justice. This hearing has been centuries in the making, and I'm proud that I'm here with you while you have the hands of justice making a difference in the lives of people.
Thank you.
I don't know of anybody else who would be doing this, Madam Chair. You're unique in all of history.
Wow.
Now, to my 6 friends, I have a question for you. If you find that your bank owned slaves or accepted slaves as collateral, would you publicly atone for this seminal sin? Mr. Solomon, a person of goodwill, would you publicly atone if you find that your bank owned slaves or accepted slaves as collateral? Yes or no, kindly, please, sir.
The bank has never owned slaves, so I don't think it's something that I'm in a position to opine on.
Well, let's just assume that you could be in error, sir. If you
We were established in 1969, sir. We were established
well, sometimes things happen between
18. We were established in 1869, and through our history, we never owned slaves. We had no involvement with slavery.
If you found that you did, would you atone?
I'm not going to speculate on something that's not correct, sir.
Quite regrettable, sir. Quite regrettable. Mr. Scharf, if you found that you owned them or had slaves as collateral, would you atone?
Yes, Congressman.
Thank you, sir. Mr. Moynihan, if you found that you had slaves as collateral or your bank owned them, would you atone, sir?
Yes, sir.
Mr. Gorman, if you found that your bank owned slaves or had them as collateral, would you atone?
Well, like Mr. Solomon, we were founded more recently, 1935, but yes, I would
The
atone.
question is, you would atone. Thank you. I appreciate it. Ms. Fraser, similar question to you. Fraser? I'm having some technical difficulties on my end. It may have something to do with the question, Madam Chair. Ms. Fraser, again, I'm having technical difficulties. Listen, Madam Chair, I'm going to have to ask if you would give me an additional minute of time. Something is happening.
I want to unmute. Okay, Mr. Green, you're absolutely correct. There is some problem, and I don't know what it is at this point. I will ask the staff to try and find out what is going on. Would you attempt to stop? What is with us? Okay. Would you try to start again, Mr. Green?
Yes, ma'am.
And we will certainly make up for the time.
Thank you, ma'am. Ms. Fraser, I'm now you. Ms. Fraser, I've got to tell you that I believe that some of the things that have been done on this committee are in part responsible for your occupying that seat. But be that as it may, Ms. Fraser, would you atone if you found that your bank owned or had slaves as collateral?
We would absolutely accept responsibility, yes. We believe we never have.
Thank you, ma'am. Now, Mr. Dimon, my dear friend, and I say that sincerely because of something that I know that you've done that was very positive. Mr. Dimon, at this hearing in 2019, you acknowledged that JPMorgan had accepted slaves as collateral, according to the bank's own analysis. But let's strike that. In addition, I would say Citizens Bank and Canal Bank in Louisiana, both now a part of JPMorgan, served plantations from the 1830s until the American Civil War. These banks sometimes took ownership of slaves when the plantation owners defaulted on loans. Between 1831 and 1865, these two banks accepted approximately 13,000 slaves as collateral and ended up owning about 1,250 slaves. Mr. Dimon, there can be no redemption without recompense. Mr. Dimon, will your bank atone for the ownership of human beings? Madam Chair, I cannot hear Mr. Dimon.
I cannot hear him either. Would you try again, Mr. Dimon?
You're muted, Mr. Dimon.
Mr. Green?
Yes, ma'am.
We're going to try and work this out. Staff, can you help me to find out what is happening? Mr. Dimon is indicating that he is not muted, but we can't hear him.
Can you hear me now?
I can hear you now.
As well as I.
Okay, I said that that the company did research and found out that companies have been bought many years earlier. In fact, did take collateral, slaves as collateral and ownership in some cases. We apologize profusely at the time. And as you know, we're making extraordinary efforts to help lift up the Black and the Latinx communities.
Mr. Dimon, the question is, will you atone in the form of some sort of redemption so that you may receive redemption? Because there can be no redemption without some sort of recompense. What will you do to atone for your banks owning human beings? This is not about what you're doing. All of the other banks are doing these things that you're talking about now. We're talking about the ownership of human beings, Mr. Dimon. What are you going to do about this? And I want it directly linked to the ownership. You must say, Mr. Dimon, we own them, and here's what we're doing to take correct. Find those families. Find those families that are still with us. Atone. Will you atone?
I would love to come see you and figure out what you think we could do that would atone properly to the families that were damaged by these activities 200 years ago. So I'd be happy to do that. I just can't make it vague.
I'm going to accept your offer. I'm going to accept your offer because once before you and I had an opportunity to resolve a circumstance, and we did. I accept your offer, and I look forward to meeting with you. And I'm going to ask that your staff contact my staff immediately so that we can arrange such a meeting.
Done.
Thank you.
Thank you very much. The gentleman's time has expired. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairman. I want to thank all of you for coming before the committee today. Just in background, I am from Texas. I'm a small business owner for 51 years. I still own my business. I'm a car dealer, and there's never been a day in my life that I haven't owed money to a bank. And with that being said, I've said it many times, the United States banking system did to what it did to respond to COVID-19 and get PPP money into the hands of struggling businesses was something no other country, I believe, could have pulled it off, and no other banking system. I know you had employees working around the clock when PPP first opened to process as many loans as possible and help your customers in some of the most uncertain times of the pandemic. Your banks were instrumental in making that happen. So I want to start off by saying thanks to you and all your employees on behalf of the millions of small businesses that were able to survive because of their hard work. We all know that a strong banking system is essential to building a strong economy. Your institutions and the community banks they help and support allow entrepreneurs to get the necessary capital to start their own businesses, expand operations, and hire more people. And we need to make sure you can continue getting money out to Main Street America and supporting small business owners like myself and others instead of navigating additional regulations and reporting requirements from the federal government. My hope is we can all get your banks hiring more loan officers and compliance officers over the next few years so we can get our economy back on track and away from this liberal socialistic agenda that we hear from the Democratic left. So my first question to you, Mr. Moynihan, did your bank run into any government regulations during the pandemic that prevented you from making additional loans that we as Congress should be looking to reevaluate as we look to get the economy back to pre-pandemic levels?
I think obviously there's a lot of regulations we could think that could be fine-tuned based on what we learned in the pandemic, some of the liquidity rules and stuff, which are quite technical. But even to the question of these small loans, the Federal Advisory Committee just gave the Fed a presentation of which the 12 banks are representative of all the banks said, we need to work on the appraisal process, the appraisal regulations, because for these smaller balance loans, it might be a $50,000 loan, which is going to have a property improved to go to $100,000 or something like that. The appraisal guidelines would never let you go to the $100,000 loan. So I think there's ways that we can, with the safety and soundness of this industry and the great work they've done, move some of these rules, knowing that the banks, are well regulated, well capitalized, very liquid, and could help. But sometimes those rules do constrain us. That's just a very specific example, which was a topic earlier in the conversation.
Well, when you have these rules, it affects your consumer too. So the less regulations, the better the consumer service gets from you. So the Biden administration has proposed increasing taxes. We talked about this already this morning to pay for the progressive wish list that is being discussed in Congress. But if we increase the corporate rate or raise the capital gains tax, it will make the long-term economic prospects of America much less attractive. We know this. We all know that when the government takes a larger portion of any business's profits, it will cause them to invest less back in their own operations and be very defensive. But for global institutions like your own, all of you, these actions would be even more detrimental. This would increase the competitive advantage that the international banks have over all of the institutions that are before us today. And my question to you, Mr. Dimon, can you discuss the challenges that your bank currently faces against international competition, specifically China, and how raising taxes, as the Biden administration wants to do, could make the challenges even harder for you?
Yeah, thank you. So I think the way to look at this is, obviously most of these banks are doing fine now, and people often say, because you're doing fine, it's not a problem. But over a long period of time, we have to compete with the Chinese banks. And I think they have huge advantages in terms of how their regulations are dealt with and how ours are calibrated around things like G-SIFI. In America, it was gold-plated, so we all essentially have to hold much more capital than our Chinese or Japanese competitors. That would be a very big one. And another one would be how the LCR, the liquidity ratio that Brian mentioned, stops us from doing a lot of intermediation in the markets that we could otherwise do in the United States.
Well, thank you for that answer. And less government regs works better, lower taxes works better, and keep our economy going. With that, Madam Chairman, I give you back my time.
Thank you very much. The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thank you, Madam Chair. And to our panel, I would just want to restate my thanks to all of you for leading your institutions through a difficult time. And I want to also agree with Mr. Williams in terms of your lending through the PPP program. It wasn't without hiccups, it wasn't without some glitches, but it was pretty solid. And so I want to thank you for both of those. Mr. Solomon, in his opening, credited Dodd-Frank for the ability and the strength of the banking sector as it went into the pandemic, as it has come through the pandemic, to one of the things that's helped the banking sector be a strong shoulder to rely on during this period of time. Can all of you raise your hands if you agree with the way I've paraphrased his testimony? If you think Dodd-Frank is due some credit for us getting through the pandemic. So I see Mr. Gorman, Mr. Dimon, Ms. Fraser, Mr. Scharf, Mr. Moynihan, and Mr. Solomon. Thanks. I appreciate that because, and I appreciate what you said, Mr. Dimon. There's always an issue, too much capital, too little capital. But everybody came into this thing strong and was able to absorb a real shock to our economy. So thank you. Mr. Scharf, I've got a couple questions for you. As a customer of the bank for, I was told, 44 years, I just want to understand where you are on the various consent orders that the bank has had to enter over the course of the last several years. I think there's been some progress. I'd like to hear where you are.
Yes, Congressman, we believe we're making progress, but we're also very, very clear that this is a multi-year journey, just given the amount of work that has to get done here. We have made extensive changes inside the company, from the management team to how we run the business, to how we prioritize the effort. And the way we are going about this work is completely different than it was in the past. Ultimately, this is all about creating a sustainable set of systems and processes inside the company that's appropriate for a company our size and complexity. And so we are completely committed to having this be our number one priority. And ultimately, our regulators will decide when each of the individual pieces of work are done to their satisfaction.
Okay, thank you. And as I said in my opening, as the chair of the CPFI, two responsibilities in that committee. One, the solvency and stability of the banking system. Two, consumer protection and making sure we don't face increasing sharp practices in financial sector. And Ms. Maloney described the Credit Card Act that she passed a number of years ago. I'm concerned that we see some practices seeping back into the financial sector. And so, Mr. Dimon, I've had a couple complaints raised with respect to Chase credit cards, that the default rate has been increased substantially, even as the bank has been making substantial profits. It must be your mic, Mr. Dimon. Somebody's mic. Let me go. So I guess the question is, has the bank increased the default rate under its credit cards to most of its members?
Mr. Dimon, can you hear me? Would you check? Are you unmuted? All right. Let's try again. Let's try it again. One moment, Mr. Perlmutter, and we'll make up for the time. Staff, can you help us out? Now it's on my phone. One moment.
Why don't I just have him answer that at some point in writing?
He can hear you, Mr. Dimon, but we still can't hear. Go right ahead, Mr. Perlmutter.
Okay, I was just, I'll just end, Madam Chair. I would just make one statement on Archegos. The Justice Department is open to inquiry into that, and I just advise or just recommend, as all of you know, keep your investments transparent and minimize the risk. Last thing I'll say, Madam Chair, as a heads up to all of you, our subcommittee is probably going to have a hearing in the near future on what does the banking sector, what does your bank look like in 10 years? And we know you do that kind of scenario planning, and we're interested in that, having that as a subject of a hearing. Thank you.
Thank you very much, Mr. Perlmutter. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thanks, Madam Chair. And I was with you on trying to run this hearing remotely. I hope we can get back to the hearing room so that we can do this in person and not have these distractions. So thank you for endeavoring to get that done. Thank our witnesses for spending 2 days on Capitol Hill talking about issues of importance both to your companies, your shareholders, your employees, as well as to members of the House and Senate. We appreciate your perseverance, and I know you appreciate the 5-minute break every 2 hours. A lot of the questions have been geared towards the bank's political agenda or joining in on the political agenda inside the Beltway, responding to progressive pressures from the left. And as a former bank CEO, having been in your shoes, albeit at a community bank, both public companies and private companies, I'm not going to spend my time here today telling you how to manage your day-to-day operations. Only you and your board of directors know how best to run your business on behalf of your clients, the shareholders, the regulators, and the larger communities that you participate in. I do want to share a few thoughts on what I've heard over the last couple of days and make sure that your companies and your management teams are being thoughtful in how you respond. I want to spend my time talk a little bit about the climate risk disclosure process that we've been debating here in the House Financial Services Committee. These are mandates on all public companies, and in fact, some are contemplated for all private companies as it relates to climate financial disclosure. And it's based on the Task Force on Climate-Related Disclosure, which I've talked about in the past. Many of you have stated that you're complying with the Partnership for Carbon Accounting Financials, which claims to help financial institutions assess and disclose greenhouse gas emissions from their loans and investments through GHG accounting. But this is precisely, I think, the challenge in making this a mandate. As I understand it, this PCAF is built off the task force recommendations. And yet that task force, chaired by former Mayor Mike Bloomberg and staffed with several now Biden administration officials, states that disclosures have to be reliable, verifiable, timely, and objective, and comparable across portfolios and across industries. And yet this issue of GHG emissions, trying to come up with scope 1, scope 2, and scope 3 emissions, they say in the Bloomberg report, are very challenging and not doable right now. And in fact, they offer not to use GHG and instead use something called a carbon intensity matrix. So my concern about these mandated disclosures are we're not ready to do that in the financial industry that will really provide value to investors. I believe you all echoed something to the effect in a question answering Senator Smith's question yesterday that there should be standardized climate disclosure. Well, that would be good sometime in the future when I think that's possible after study and agreement industry by industry. And I think Mr. Barr covered that topic well. Let me turn to China and ask you, Ms. Fraser, about how you're thinking about China as it's changed its economy since 2012 and 2013 to be more aggressive in trying to displace the U.S. as an economic leader in the world and exerting its military. This is something we've never faced before, where we're trying to do business with a big country, and yet how do you assess the risk to your doing business in China?
Yeah, we serve multinational companies from all over the world, many great American companies that are participating in the growth in China. We follow our clients to where they're doing business. Obviously, there are concerns around a number of different topics in China, from human rights and the military financing, and we certainly would never finance any institution that's involved with the military in China and the financing of that. We see them playing an increasing role around the world. And again, I think it's one of the reasons it's critical that we have American banks playing a role globally.
Well, we appreciate American banks leading the charge on economic freedom at home here for that student just getting out of an HBCU looking for a job and buying a house, but also around the world. But I think risk management is putting your company at risk and your clients at risk, because it's hard in that opaque system and the one belt, one road approach for you to be able to judge what's a good deal and a bad deal and what's a compliant deal and what's not a compliant deal. Mr. Dimon, I want to welcome you to Arkansas. Glad JPMorgan Chase is coming to Arkansas. And I want to submit a question for the record about the Federal Reserve policy, and I'll do that. Thank you, Chair. Yield back.
Thank you very much. And we're going to take a 5-minute recess to see if we can straighten out the little technological problem that we have. I do not want Mr. Dimon to miss his opportunities to share his thoughts with us. And so we will be in recess for 5 minutes. to order. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Madam Chair. It was reminded me of the movie Young Frankenstein. Every time they said Frau Blücher, the horses would get scared. Every time they said Jamie Dimon, it looks like the computers would get scared. Thank God we fixed that. One of the most remarkable things that I heard today was the first 3 people that spoke, and again, thank you, all of you, for being here, spoke with really some pride, I think, in being either sons of immigrants or immigrants themselves. I think, Mr. Dimon, you said that you were the grandson of Greek immigrants, and I think that Ms. Fraser, you stated that you were an immigrant, and certainly your elegant English proved that. And then Mr. Gordon, you stated that you were an immigrant, and your English proved that. Sorry, but and then Mr. Moynihan, I was surprised that you broke the daisy chain with a name like Moynihan. I knew Daniel Patrick Moynihan. He used to come to Fordham when Father Joe Hare was the president. I was a Jesuit scholastic at the time, and they used to have great stories about being Irishmen. The reason I mention all that is around here, oftentimes you hear, sadly, ugly words like illegals and anchor babies, and even one member said wetback, although he did walk it back to be truthful. And I guess I look at immigrants the way that the Bible looks at immigrants. In Leviticus, if you recall, it says, when an alien lives among you, treat him as your native born, because you too were immigrants in the land of Egypt. Or in Matthew 25, when I was hungry, you gave me to eat. When I was thirsty, you gave me to drink. When I was a stranger, you welcomed me. So once again, thank you for pointing that out. And thank you again, Mr. Dimon. I think you said that hopefully we'll get back to public policy and do it right as Americans. And one of the things that you mentioned was immigration. And I hope that we do that. And thank you again. One of the things that I used to hear here all the time was Dodd-Frank, how terrible it was. That's all the Republicans could talk about. In fact, I thought it was the spawn of Satan or something. And now, not a peep out of them. Now we hear it instead from the bankers saying, hey, it's working well. It worked well. We need to adjust it here and there on some of the leverage issues. I understand that, but it worked well. Now, of course, the spawn of Satan has become these environmental issues. Oh, and I believe deeply in ESG and that we have to have metrics. But now you hear them saying, oh, this is terrible. It's a horrible thing. But the reality is that the environmental issue is important. So is the social and governance aspects. Now, it seems to me that you guys do take them seriously. Why don't I ask first, Mr. Let me see. I believe that Mr. Moynihan, you take these things seriously in your bank, do you not?
Yes, we do, and we publish an ESG report like many of my colleagues do. And we've also, just to go into the metrics to measure it, we've been working with the big 4 accounting firms and have 80 companies have signed on to voluntarily disclose what we think the relevant constructive metrics are that are different, that take the best of what's out there but make it simple so a company can actually do it. And that way we can then stay with those oil companies who declare what they're going to do and help them make the transition that they've all declared.
Thank you. Does anyone not think that the environmental issues and ESG is not important? If you don't think it's important, speak up right now, please. Let the record reflect that I didn't hear anyone speak up. See, the reality is that the climate is changing. And if you even listen to some of the people that are even Republicans, the leader of the World Food Program saying there's 280 million people marching towards starvation. And why is this? Because of conflict and because of environmental change. Those are the 2 things. We have to take these things seriously. And I'm glad that the banks are. I don't have a whole lot of time here, but I do want to talk about foreclosures. I am very concerned because June 30th is when forbearance goes away as a federal issue. And I heard some of your statements earlier, but I hope you do work with these customers because I think that last time this happened, you didn't do a good job and you got a black eye because of it and you deserved it. But this time I think you have an opportunity to work with people because of this wasn't their fault. I mean, this was a pandemic, for God's sakes. Work with these poor people to make sure that they can stay in their homes And I think that this time you won't get that black eye. It'll be just the opposite. You'll get praised for it. So again, my time's up. I thank you for especially the immigration. Mr. Moynihan, next time, do not break that daisy chain, for God's sakes. You should have continued it. Thank you.
Thank you very much, Mr. Vargas. Now the gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
The chairwoman, I think our colleagues, and I think our witnesses. For our witnesses, I think what an interesting time it must be to try to navigate these waters as CEOs of some of our nations and frankly, some of the globe's largest banks and financial institutions. What we've seen today is essentially the challenge of navigating this new woke heresy code. If you transgress it, you're forced to repent publicly. Who knows what remuneration or other penance you might be called to pay for the sins of people past, but be assured there is no grace in this new woke heresy system that some of my colleagues are trying to foist upon our country. And the other challenge is you have a similar authoritarian regime in China, the next largest economy, trying to force their system on us. I will at least say that in China, they're completely hypocritical. While they're engaged in horrendous acts against the Uyghurs, they ask to pretend that there's a moral equivalence between China and the United States conduct with respect to treating of ethnic minorities. Certainly, we can acknowledge sins of the past, but we should focus on the sins of the present. So I appreciate the challenge that you all have to navigate so that you may be permitted to operate your businesses. So the challenges are difficult just talking about the politics, but let's get to the actual policy. So, Mr. Scharf, in recent stress tests, the Federal Reserve completed in December 2020, the large bank post-stress capital ratio was 9.6%, more than twice the regulatory minimum. Obviously, this is reassuring because it shows that large banks are adequately capitalized. However, do you think that it also shows that our current capital requirements may be out of balance and the Fed should revisit these issues? Do you believe that this approach could be impeding economic growth?
Congressman, I think there's no question that the banks have a substantial amount of excess capital at this point. The results that come out of the stress test are obviously very idiosyncratic to what the individual assumptions are for that scenario, as well as each of our position. So I think it's hard to draw a conclusion from any one specific stress test. But I do think that when you look across the industry, there's an exceptional amount of capital in the system. Also because of the restrictions that the G-SIBs have had more recently.
Thanks for your answer. I would love to spend more time on that, but I have a couple other topics I want to get to. Mr. Dimon, last month reports were circulating that JPMorgan was looking to offer a Bitcoin fund for private wealth clients. I've been following your rhetoric on cryptocurrency. I've spoken to you in the past about cryptocurrency. But you've obviously walked back comments from saying Bitcoin was a fraud to now saying it might not be your cup of tea. And that you do agree that regulations are needed, but you believe it's important for Congress to provide regulatory certainty so that firms such as JPMorgan can offer additional crypto products. Can you describe how your views have changed over the past few years on this important area and why Congress needs to provide regulatory clarity for this asset class?
Yeah, so they haven't changed that much. And put aside blockchain and put aside stable coins, which is supported by assets. Something that's not supported by anything I do not believe has much value. My own personal advice to people is stay away from it. That does not mean the clients don't want it. This goes back to how you have to run a business. I don't smoke marijuana, but if you make it nationally legal, I'm not going to stop our people from banking it and et cetera. I don't tell people how to spend their money, regardless of how I might personally feel about some of the items that people might buy with their money, stuff like that. So we're debating, should we make it available in some way, in a safe way that people can buy and sell it and put it in the statement systems. But my own personal view, it's nothing like a fiat currency. It's nothing like gold. buyer beware. And I do think that eventually the regulators who are day late and a dollar short should be paying a lot more attention to the future, like payment for order flow, high frequency trading, cryptocurrency, and put a legal regulatory framework around it that at least protects.
Thank you so much. In the last few seconds I have, I would just ask that if any institutions represented here today have policies that prevent your donor advised fund donations to certain 501c3 organizations based on political affiliation or causes they support, could you please coordinate with our office? We're trying to understand who's blocking people from using the donor advised funds they have established. And frankly, my concerns aren't so much with the GSIBs, though they're not absent. It is an issue broadly, and we'll be working on a letter soon to address to the SEC. My time has expired, and I yield.
The gentleman from Illinois, Mr. Foster, is now recognized for 5 minutes.
Thank you. And am I audible here?
Yes, I can hear you.
Yeah. Okay. Thank you. Many of you were probably on shift 10 years ago during the Tea Party default crisis of 2011, when federal debt suffered a ratings downgrade that was caused when newly elected Republicans threatened to default on the U.S. debt by blocking an adjustment of the debt limit. The resulting panic cost the stock market over $1 trillion and cost the average American over $10,000. It also delayed the economic recovery by somewhere between 6 months and a year. Now, normally Treasury bonds are some of the safest instruments in the world because the U.S. has always paid its debts. Many other rates are pegged against U.S. Treasuries, including mortgage rates, which are fixed against the 10-year Treasury. And a default caused by failure to raise the debt ceiling would impact our housing market and hurt hardworking Americans in many ways. And so in the United States, we have this anomalous rule called the debt ceiling that does not occur in really any other advanced country and triggers an automatic default on treasuries. Now, there are troubling signs politically that we may be headed for another default crisis. And so my question to you is, how do you handle a default on U.S. treasuries in your risk management and stress testing? Oh, Jamie, everyone always picks on Jamie, so I'll let you go first. I mean, how do you manage such a risk? And what would you do the day after we defaulted on treasuries?
I hope that we don't have to start doing a review of that again. It would be an unmitigated disaster. We spent like $50 million just investigating that issue, if I remember correctly. And I don't want to have to brush up on that, but there's some very complex questions which you shall have to answer. Do treasuries cross default? Can the Federal Reserve buy default to treasuries? What happens to default to treasuries in pension plans, investment plans, bank accounts, accounting rules? It could cause an immediate, literally a cascading catastrophe of unbelievable proportion and damage America for 100 years.
Oh, thank you. I think that's a pretty good summary of just everyone that's looked at this. And, again, this is an instance where I think we need one of these red flag rules that removes a gun from Congress's hands. And, as you may be aware, there have been numerous proposals to permanently repeal this debt limit rule that triggers the automatic default. By members on both sides of the aisle. And frankly, both parties have been guilty in weaponizing the default. When George Bush went and spent a lot of money on a war and then lowered taxes, the Democrats gave him a lot of grief over the necessity to raise the federal debt when that happened. And, it's the same thing has happened in mirror image. And so I think it's really important that people at this time, when it's not an emergency, just step back and say, yes, this is one of the good workman-like fixes that we should put forward on a bipartisan basis, because the threat is so real and the benefits are near zero. So does anyone else have comments on specifically, do you actually, because the odds are not zero. You can see threats already happening from the other side of the aisle. Oh boy, we're going to go cause trouble over the debt ceiling. Do you actually have planning sessions where you say, what do we do? Or is it just one of these things like planning for a nuclear war that's so bad that you can't really realistically plan for it? Will any of you just indicate that you actually, this is part of your normal planning, dealing with a federal default?
We take a look at lots of tail scenarios, and this is one of them, but I think as Mr. Dimon said, it's imponderable to think that we would get in the position, and I think the market often takes great comfort at the time this comes to the fore when bipartisan people say it won't happen, but I think it's something to be very careful about. So we take into account as a tail risk, and it would be very bad.
Okay, well, unfortunately, I think you should start taking the possibility more seriously, and maybe think about using some of your political muscle to encourage members on both sides of the aisle to hold hands and jump on this, and just take this disaster scenario that really provides no benefit to our country, to just take it off the table once and for all. That was the point I wanted to make, and with that, I'll yield back.
Thank you very much. The gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for convening today's hearing, and I do thank the witnesses for appearing. Mr. Moynihan, if I could to you, there was a story that posted within the past few hours to the Wall Street Journal website. And I'd like to read the headline. The headline is Biden budget said to assume capital gains tax rate increase started in late April. In other words, it would be retroactive. And it says Congress must still approve any rate changes and retroactive effective dates. My question, Mr. Moynihan, to you is, if a retroactive capital gains tax rate increase were to become a reality, would that have a negative effect on the economy? And if so, how?
I think if you think about it from two sets of people, general investors, and the capital gains rate affects all investors. Many investors invest even through mutual funds and stuff, and the capital gains that report out to them at a higher rate would affect them. But importantly for businesses, small businesses, trading hands and stuff, retroactivity is sort of never in anybody's mindset, and I think it would have a bigger effect if it were retroactive than if it could be planned for in the future. But in any case, those businesses are very worried about it, as we said earlier.
Thank you, Mr. Moynihan. Ms. Fraser, can I ask you those same two questions as it relates to that Wall Street Journal story?
Thank you. I very much agree with Mr. Moynihan that retroactivity creates a lot of confusion, and I think unnecessary consternation for investors and for companies involved that should be ideally avoided. We're in a very low rate environment at the moment. We're seeing a lot of savers, which includes retirees and pension funds and others, moving to longer dated assets, and therefore a change in these rules would have an impact on that at a time when the returns on people's savings are already low.
Thank you, Ms. Fraser. Mr. Solomon, can I ask you those same two questions, assuming that story is true and it became a reality? Would it have a negative effect on the economy, and if so, how?
I think any time, and I think both of my colleagues have commented on this. Uncertainty obviously dampens growth and dampens activity, and so anything that's retroactive creates extra anxiety and extra uncertainty, and that would just slow down economic activity. And so I think retroactivity is something to be very, very cautious about. And I do think, a chilling of investment activity through higher capital gains tax is something to also think through carefully.
Thank you very much. Mr. Dimon, can I ask you those same two questions?
Yeah, I can't add anything of substance to what my colleagues have already said.
If I could take it one step further, there's been talk of other tax hikes. On this hearing today, we've talked about a possible increase in corporate tax rates. If there were any tax rate increase this year as it relates to any taxes, and they were retroactive as it relates to any tax increase, would that be negative as it relates to the economy?
Yes, but pretty much like my colleagues already described. But even more so because it relates to business.
Thank you. Mr. Gorman, can I ask you, please, those same two questions, assuming that story is true, assuming that Congress were to enact retroactive capital gains tax rate hikes, would that be negative to the economy, and if so, how?
Yes, because every business and every individual deserves to know what the tax regime is when they're making their decisions. So by definition, my view, any retroactive tax is unfair and not good for confidence and sentiment.
Thank you, Mr. Gorman. And Mr. Scharf, if I could ask you those same two questions in my remaining time.
I agree with what everyone has said, and I would just stress what James just said. People make decisions based upon a set of rules that they believe are in place. And if you change that, it calls into question any future decisions that people make and could be quite harmful.
Thank you, Mr. Scharf. Madam Chair, with my remaining 16 seconds, I yield back.
Thank you very much. The gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Madam Chair, and to our witnesses for being here today. Very grateful. Nearly 50 million Americans don't have a credit score and are left out of the traditional banking system. According to the CFPB, Black and Hispanic adults are the most likely to lack credit scores. This absence of credit history limits opportunities to qualify for student loans, a small business credit line, or a mortgage to buy a home. Mr. Dimon, if I can start with you, sir. Your bank utilizes information on your customers' banking activity to extend credit. Has this been successful in providing access to credit for more customers who may not otherwise be eligible? And what are some of the benefits and risks your institution has had to navigate in utilizing this source of information?
Yeah, so we've been using alternative sources of information to provide credit. This is a great way we all can work together. I don't know if you saw the article that all the banks are now sharing banking data with each other in a way to extend more credit to those who need it. I think it's a great way we can all accomplish some of the same goals we all want.
It's been projected, so reported that out of your bank's participation in Project REACH, the OCC program to increase access to credit for underserved communities, as you were referencing, JPMorgan will be working with other banks to exchange data to further identify creditworthy customers. What more do you think we can be doing to expand credit access for underserved communities?
We're going to be using a lot of alternative data, like do you pay your rent on time? I'm almost going to call it reverse discrimination. Seek out those who have good credits that are not in the normal credit system, including immigrants who are here that have credit histories in their foreign countries. And so a lot of ways to do this, and we completely applaud Project REACH.
Thank you, sir. Mr. Moynihan, your bank has more than 23,000 employees in New York City and New Jersey. Every day we're hearing more and more about families fleeing from New York and New Jersey because of, especially because of affordability, therefore moving to low-cost states like Texas and Florida. Do you support making it more affordable to live and work in North Jersey and New York by reinstating the state and local tax deduction, in other words, known as SALT?
I think the SALT has had an impact that has been well written by. I think our job as banks is to continue to support the people who are in those communities. Interesting enough, if you start to see the fact that alone we're bringing back probably 6,000 kids who have never really resided in New York City over the last 3 years are now coming back to work. I think you'll see a lot of positive momentum in some of the housing in New York in just terms of filling up those apartments, which then that were empty and things. So we've got to do it through our lending. We got to do it through our employment, but also it would be helpful, I think, if the tax rates are more normalized.
Thank you, sir. Mr. Solomon, I know that Goldman Sachs does not have desks that are actually involved with trading cryptocurrencies. But I understand and I know your bank can't own or trade cryptocurrencies for regulatory reasons, but you have many clients who are coming to you for advice on investing in digital assets. How do you help them navigate the risks of cryptocurrencies like Bitcoin?
So I appreciate the question, Congressman. And you heard a little bit from Jamie on this. There's a lot here, and it's there is no question that both institutions and individuals are looking for exposure to Bitcoin. We're trying to provide information to them around the potential asset class. Like Jamie, when you talk about cryptocurrencies, like Bitcoin specifically, I'm extremely cautious. There's no question that if lots of people believe in something, it can sustain value for a period of time, but the use cases are relatively unclear, and the regulatory and government oversight is still relatively unclear. And so there's a lot of work to do around this. I think buyer beware is absolutely the right thing to think about, but there's no question there's significant interest, and so we're trying to help our clients and track it accordingly.
Thank you so much. Chairwoman, I yield back my time. Thank you so much.
Thank you very much. The gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
I thank the chairwoman and thank again our guests for being here. So I've long supported the services that banks provide to our communities and the great work that you all did during the pandemic, supporting consumers and small business. It's a prime example. So that's why it concerns me. The financial institutions really shift their focus and moving from carrying out political and social agendas instead of just providing capital and liquidity to consumers and to businesses. So as an industry, I really believe that you should be focused on being a good neighbor by providing greater value to your consumers and your shareholders. So I want to ask you all a yes or no question, and I'll go around. But as your banks begin to shift your business decisions and include more ESG or environmental, social, and governance goals, are any of you all concerned that this may cause affected industries? And I think of, as an FFL, I think of legal firearms, and I want to add coal, oil, et cetera, that have thousands and hundreds of thousands of jobs in this country. Are you concerned that with more ESG and banking that they could lose investors, forcing these businesses to move operations overseas or even close and create job losses here in the U.S.? And Mr. Moynihan, as a North Carolinian, I'll start with you.
Well, Mr. Budd, I think a perfect example is what we did with Duke Power in our backyard there. We basically, because of their commitments to provide more clean power and our commitments to buy more clean power, we put up a large installation which now other people can purchase from. So I think these commitments are consistent with good business and growth in companies. And Good and Duke Power, a major power company that has all sorts of sources in their environment. We help them make a contract come to life. So there's a great business opportunity. I think we all have to have judgment at the pace of the transition to make this happen.
Thank you. And I want to just make sure I understand the question as I continue.